My Lord Mayor, Commissioner, Excellency, ladies and gentlemen, we are now ready to start our conference. I would like to thank you all for being here with us today. Those who came from close by in London, as well as those who have travelled from all over the European Union and beyond, to be with us here today and listen to what the EBA and its stakeholders have to say. The Lord Mayor of the City of London, who represents the City of London Corporation and has graciously offered to host and support the EBA conference today in this beautiful historical building, will soon join us to open the conference. The Chairperson of the EBA, ANDREA, will then greet and welcome you, before the Commissioner, Jonathan Hill, joins us with a keynote speech. We will then start with our two panels, which will gather the views of some important actors in the banking sector on the past 5 years, as well as on future directions. Both panel discussions will be followed by a session of questions and answers. We are keen to ensure interaction with you, both those here in the room with us today and those following our webcast online. The moderator of the panel will let us know once the time for questions has arrived. We would recommend that you raise your hand if you have any questions, and our staff will be carrying around microphones in the audience. Similarly, those watching the event on the EBA website are welcome to submit their questions through the EBA's Twitter account, which is @EBA_news. We will try to take as many questions as possible, but you will have to excuse us in advance if the time allocated does not allow to take all the questions. A coffee break will then take place after the first panel at 11 o'clock downstairs. And at the end of the morning, we invite you to join us downstairs for a toast. While we wait for the conference to start, and those who are just arriving to still take their seats, you may also want to check that your mobile phones are on silent. I would also like to remind you that this is a public event, so any of you reporting on this, as well as the media representatives joining us today, will be able to quote any of our speakers or any other interventions. We would just kindly ask you to please refer to the fact that whatever you report on has happened at the EBA 5th anniversary event. So we hope that you will enjoy the next few hours with us, and please feel free to refer to the EBA staff in the hall throughout the event. Let me now introduce you to the Lord Mayor of the City of London, who hosts this EBA event and will take the floor to welcome you today.
Chairman, Commissioner Hill, Your Excellency, ladies and gentlemen, welcome everybody to the magnificent Guildhall, where we celebrate the 5th anniversary of the European Banking Authority. It's a real honor for me to be here, and may I venture that there is no setting more fitting than this one. Guildhall has been through some tough times in its 600-year history. It was the only secular building in the neighbourhood to survive the Great Fire of London 350 years ago this year. Then, during the Blitz, it was severely damaged again after a bomb landed just outside. Both times, the walls were blackened with soot, the wooden roofs collapsed, and the windows melted in the heat. But the structure remained standing, defiant, thanks to the hard work of the men and women who helped to extinguish the fires and protect and preserve the foundations. The EBA's role is not dissimilar. When the EBA came into existence 5 years ago, the reputation of the financial services sector was at a low ebb. But with your help and the help of others, including regulators and the industry itself, changes have been made and things are looking distinctly brighter. European banks have enhanced their capital position, which is now stronger than banks in the US. You have improved transparency, publishing detailed data on more than 100 banks. And the single rule book has been put in place after extensive engagement with practitioners. Thank you and congratulations for this work, and more besides. And from a personal point of view, I'm delighted that the EBA is based in London, the leading financial centre for not just Europe, but the world. London's location, reputation and expertise mean it is the most important bridge between the single market and global markets. It is vital that those links with the wider markets are maintained. The competitiveness of the single market relies on its internationalism, its engagement with the global economy, which is of great benefit to Europe and the world. Long may it continue. Ladies and gentlemen, in 43 years as a shipbroker, working all over the world, I know that the single market is a monumental achievement. It has created jobs, stimulated economies, and improved consumer choice. But like all good business, it must be protected and be developed to allow Europe to realize its full economic potential. The EBA recognizes this. You have correctly made the link between regulation and the success of the single market, and highlighted this link to no less than the EU Parliament and the Council. After the first 5 years, thick with regulatory change, we can now reflect on what has been done and what the effects have been. But we should also think about added value. In other words, how do the bank's customers benefit from what's been done? I understand that the European Commission intends to review the impact of the financial reforms that were introduced after the financial crisis. That is a positive step, and it will go a long way to compensate for the fact that while the crisis was going on, there simply wasn't time to carry out full impact assessments. I hope that the Commission's review will help to identify the inconsistencies and contradictions that pepper the legislation that has come out of the crisis. Much of this regulation is yet to come into effect, which makes it easier to root out those inconsistencies. But there is a flip side. Until the legislation has come into effect, and until the new rules have been bedded in, it is almost impossible to assess fully the cumulative impact of regulation. We just don't know for sure if the changes we make are having a positive impact on the high street. The answer is ongoing assessment, keeping a continuous watching eye over the changes that have come in, recording their impact and using those records to make evidence-based amendments to legislation. That is the way to simultaneously shore up the integrity of the sector while still protecting economic growth and employment. This process will work particularly well if we pair it with a constant focus on standards and conduct. Here in the UK, we have some recent and notable expertise in that area. In June last year, Mark Carney, the Governor of the Bank of England, launched the Fair and Effective Markets Review, or FEMA, which was a joint initiative by the Bank of England and the UK Treasury. But here's the thing. The Bank and the Treasury didn't just get in a room and write it themselves. There was proper consultation and engagement with the practitioners themselves, who are always going to be the first line of enforcement for new rules and regulations. Based on their engagement with practitioners, the review recommended an ambitious but realistic program of mandatory exams and continuous professional development for FICC employees. This new regime would have a particular focus on the standards of conduct that should be expected by everyone involved in the FICC markets. The combination of tougher rules, enduring standards, and a disciplined focus on professionalism is what the markets need and people want to see. FEMA was and is a very big positive development. And speaking of positive developments, this anniversary conference will cover some of the most important and exciting trends in contemporary financial services. One of these is fintech. The City of London Corporation, which I head, is a ferocious supporter of this hugely exciting opportunity, which brings together the UK's existing strengths in financial services and our burgeoning tech expertise. London employs over 44,000 people in the sector, more than New York, and 4 times as many as Silicon Valley. Earlier this week, I participated at a fintech event hosted by EY in Canary Wharf. Before the event, I was talking to a young European executive of a fintech startup who was full of praise for London's deep pools of capital, the progressive views of our regulators, and our excellent, ambitious people. But we cannot be complacent. We must maintain those achievements and match them across Europe. I'm sure that these issues will be up for discussion here today as part of the rich and varied mosaic of debate coming up. And as the discussions ebb and flow, as talk moves from one area to the next, moving from the challenges of the future to the achievements of the past, we can be sure of one unifying fact. If I can find it. Excuse me, put it in the wrong order here. We are absolutely devoted to the banks and other financial services as a force for good in the UK, in the EU, and around the world. That fact has informed the EBA's first 5 years, and it will continue to do so for as long as it exists. Thank you.
Ladies and gentlemen, the Chairperson of the EBA, ANDREA, will now open the event and greet you.
Good morning, and thank you very much, Lord Mayor, for your remarks and for the kind hospitality the City of London has extended to the EBA, not only today, but since its establishment 5 years ago. And I must say that when I entered this room, it came to my memory that I have in my very office a picture that was shot here 12 years ago for the first meeting of the Committee of European Banking Supervisors. So it's even longer than the 5 years of establishment of the EBA. And welcome, of course, to all the participants in this wonderful place. You represent a broad range of stakeholders with strong interest in the work of the EBA, and it is thanks to this fruitful and positive engagement with you during these first 5 years of life of the authority that we managed to achieve huge progress in the regulatory reforms and in the balance sheet repair of the European banking sector. The support of the European Commission, Parliament and Council have been of paramount importance to drive forward our agenda. The pressure from and the dialogue with international organizations has helped us to take difficult decisions in the darkest moments of the financial crisis. The spirit that we have developed within the Board of Supervisors has been essential to take clear decisions and achieve progress, also in presence of significant disagreements between national interests. The extensive dialogue with the industry, as well as with representatives of consumers of banking services, has been important to enhance the technical quality of our work and to contain the risks that the reform led to unintended consequences. But this notwithstanding, let me say that it has been a very challenging start. We have often felt alone in the face of a huge workload, with scarce resources and sometimes weak legal basis to do what needed to be done. Hence, let me take this opportunity to thank especially the EBA staff, who is well represented in the room today. If we have done something good in these years, it is especially thanks to this group of young, motivated, talented professionals from 26 European countries who have worked so hard to make it possible. I would like to spare you with a list of accomplishments in these 5 years. It would be boring, and I would surely forget something. I'll try instead to focus on a few memories, which in my view contain a distilled essence of what we have built and need to bring forward in our next steps. Not surprisingly, my first memory refers to 2011, during the first months of the EBA's existence, when the most difficult financial crisis ever experienced in the European Union reached its zenith. The EBA stress test and recapitalization exercise have been widely criticized, but I believe we managed to take three very important policy decisions that shaped the response to the crisis and that have been essential in restoring confidence in European banks. First, we decided to apply a very rigorous definition of capital in line with international standards and with the SEBS guidelines not yet applied in all member states. And we enforced this definition in a strict, uncompromising way. Second, when the sovereign debt crisis entered into its most critical phase, we agreed to ask banks to significantly enhance their capital position, also by building buffers reflecting the significant drop in the market valuation of their sovereign exposures. Third, we agreed to give extensive disclosure of banks' data in order to dispel those concerns arising out of the opaqueness of banks' balance sheets and differences in practices across European countries. In the following years, we built on each of these decisions by designing strong regulatory standards for a truly uniform definition of capital and monitoring new capital instruments, by adopting common definitions of asset quality with uniform reporting requirements, by constantly testing the resilience of banks against the risk du jour. But the most important legacy of these decisions has been, for us, for the EBA, our capacity to act and take responsibility by shaping coordinated EU-wide policy responses. This was not to be taken for granted. Our decisions were very controversial at the time, also within our board. They attracted extensive criticism from part of the banking industry. In all cases, there were reports of credit institutions and banking associations considering legal challenges against the EBA. The ability to identify common European interest and to move forward, also in presence of these agreements, has been a distinctive feature of our policy response to the crisis. The second set of memories I would like to share with you today relates to the events that enhanced our awareness of the relevance and fragility of the single rulebook, and the need to be ambitious in our efforts around that. First, when we had data collected at the EBA, we started making analysis of the impact of different interpretations and applications of common European rules across member states, and the impact these had on the level playing field. And we quantified, for instance, the impact of options and national discretions, the impact of differential methodologies for calculating the Basel I floors, and we realized how relevant those differences were and how different the outcomes for banks competing in the same market. When the crisis deepened, we realized that the common rules, not yet still under minimum harmonization principles, were sometimes bent to support ring fencing and constrain the functioning of the single market. This demonstrates the importance of our mandate to bring the single rulebook to life. And we have delivered on this mandate, producing over 150 standards and guidelines on time and to a high quality, notwithstanding severe resource constraints. But we realized that this was not enough. We identified areas where the degree of harmonization achieved was not sufficient, for instance, covered bonds, or was not working as intended, for instance, in the field of securitization. We developed advice to the Commission recommending action to restore a true level playing field, foster best practices, and an appropriate degree of conservatism in the common regulatory framework. Also, we realized that single standards had to be complemented with tools to ensure consistency in their practical implementation. We now have a centralized and integrated Q&A system which provides common answers to practical questions from supervisors and institutions. Finally, we initiated a number of investigations on potential breaches of European law and cases of mediation, with a view to ensure that the single rulebook was not circumvented by actions taken purely in the national interest. By acting as guardian of the single rulebook, the EBA laid the foundations for a better functioning and truly integrated single market. My third and last memory goes to the first confirmation hearing at the Committee of European and Monetary Affairs at the European Parliament. There, MEPs rightly sought to ensure that the EBA and its senior management were transparent in their dealing with the industry and accountable to European institutions. My colleagues at the EBA and I embraced the concept of an open and transparent authority and made it a pillar of the new organization. All meetings with industry representatives are reported on our website. We aim at an early and open dialogue with all stakeholders, always providing feedback on comments received and clear roadmaps for future works in order to ensure predictability of our actions. Our goal has always been to clearly explain what we are doing and why we are doing it. The choice of the European legislators has been to move to a setting in which the costs associated with the failure of an institution are internalized and thus first borne by its equity and debt holders. Bailouts of failing banks with taxpayers' money will be always preceded and in most cases substituted by bail-ins of their private investors. This is a relevant shift in focus of public policies. In this new world, supervisors need to be much more transparent, accountable than in the past. And I believe we firmly rooted the EBA as an open, transparent, and accountable organization and stand ready to further improve our record in this area. Now, looking forward, the agenda that we hope will receive input today in the discussions, I would like, first of all, to reassure the industry participants today that it is not in the EBA's intention to launch any new regulatory grand plan. As a matter of fact, we are as keen as you are, and probably even more, to reduce the intensity of regulatory production and shift our attentions to make the reform package work in practice. During 2016, we should be closing the implementation of the G20 reforms. Our focus will be on the calibration of the leverage ratio and on improving the consistency and reliability of risk-weighted assets calculated with banks' internal models. The EBA has just issued a roadmap, I think yesterday night, and has been receptive of the industry's request to have longer implementation timelines. One of the key tasks for us will be to better understand the effects of the reforms are having on banking structures, business models, and risk-taking. I'm not convinced by the argument that the reform, especially the new capital and liquidity requirements, are excessively harsh and hampering the recovery of the European economy. However, I would acknowledge that the regulatory framework has become fiendishly complex, especially for banks with very simple business models. Regulators have a duty to assess whether the increase in the compliance burden is always warranted, or there could be simpler ways to achieve the same prudential outcomes. The EBA made its best efforts to incorporate the principle of proportionality in its own regulatory products, but we should devote serious thought to a modular approach to rulemaking in which the complexity of the rules aims at matching the complexity of the business models of the banks in a consistent way across the single market. An important question lingering upon us is whether the single rulebook is fit for purpose in the new institutional setup created by the banking union. The single supervisory mechanism of the ECB has expressed its concerns, Daniel Nouy and Sabine Lautenschläger have been particularly vocal on that in a number of areas, rules still differ within the Eurozone, hindering the smooth conduct of supervision. At the same time, the proposals for a new settlement of the UK within the EU suggest that this need for greater uniformity of rules might not be suitable for member states not participating in the banking union, which may need a different set of union rules. I'm convinced that common rules and convergence in supervisory practices are essential to preserve the integrity of the EU 28 single market. If a multi-layer single rulebook is to be introduced to achieve this in practice, then it has to be managed in an integrated fashion to avoid that regulatory differences generate barriers and uneven competitive conditions in the cross-border business between ins and outs. And the EBA stands ready to contribute to this delicate process. The adjustment of the EU banks' balance sheets is well advanced, but not yet completed. On average, European banks have achieved a satisfactory capital position, similar to that of their competitors in the US. Asset quality is also improving, but the heavy legacy of non-performing loans is a drag on profitability and traps capital that should be used to support lending to corporates and households. Supervisors will have to maintain pressure on banks to actively manage non-performing assets and restore their lending capacity. Banks are also adapting to their liability structures to the new requirements of the Bank Recovery and Resolution Directive. The determination of the amount of liabilities that should be available to absorb losses in case of crisis, the minimum required of eligible own funds and liabilities, MRL, by resolution authorities will be a key element driving this adjustment. It will be essential that all relevant parties, resolution authorities, prudential and conduct supervisors, banks, investors, have a common understanding of the requirements and of the quality and amount of liabilities that in each case could be written down or converted into equity in resolution. Distribution of risky and sometimes complex instruments to captive retail customers remains an area of concern that we have started addressing early on jointly with ESMA and EIOPA. Finally, we have to confront the challenges of financial and technological innovation. Digital banking has the potential to disrupt current business models and raise challenges also for the protection of consumers of financial services. The EBA has already worked on virtual currencies and crowdfunding. The mandates contained in the Second Payment Services Directive will allow us to focus even more on this area. I'm sure the discussion today will help us shape our future agenda. Let me thank you all for your participation and contribution to this event. Thank you very much.
Ladies and gentlemen, we are now ready to receive Jonathan Hill, the European Union Commissioner for Financial Stability, Financial Services and Capital Markets Union, who has joined us here today from Brussels to give his keynote speech at this event.
Lord Mayor, Excellence, Andrea, thank you so much for inviting me. Good morning to you all. I'm very pleased to be here to celebrate the 5th anniversary of the EBA, and it's a particular pleasure for me to do so at the Guildhall, here at the heart of the City of London, which itself is, of course, a gateway for the world into the wider European Union. And from this building, Britain has traded with the rest of Europe for centuries. Today, investment flows out from the square mile to the four corners of the continent, and financial services, the UK's biggest export market, are sold right across the single market. So I think that today is a good opportunity to think about the rules that govern the single market and the work done by the EBA in the last 5 years to strengthen the regulation and the supervision of Europe's banking sector. So I wanted to start as Commissioner by thanking Andrea ENRIA and his whole team for all their hard work. I think it's very easy today to take for granted what they've achieved. But they have been part of a radical overhaul of Europe's regulatory and supervisory framework for banks, and they've played a very important role in making our system more secure. The single rulebook for the banking sector was at the heart of our response to the crisis. And here the EBA has helped deliver a consistent application across the single market for this new regulatory framework. And for this, their standards, guidelines and Q&As have been a great help. As we've heard, Europe's banks are now stronger and better capitalized. They hold higher levels of liquidity, and the disclosure of data has gone a long way to restore confidence across the banking sector. Last November, the EBA published detailed information on over 100 banks from 21 different countries. And those results confirmed that Europe's banks are increasingly resilient. They also helped shine a light on some of the issues that we still need to tackle, such as the non-performing loans that weigh on some parts of the banking sector. And this greater transparency, which the EBA has helped to bring, is a central part of our response to the financial crisis. In recent years, we've passed huge pieces of legislation, like the Capital Requirements Regulation, the Bank Resolution and Recovery Directive. We've created the Banking Union, a single supervisor, a single resolution authority. And it's been an unprecedented period for new bank legislation. But now, as Mark Carney said towards the end of last year, many of the big reforms have been implemented. There's a sense that the bulk of the work is done, and that is a sense that I share. While there is still unfinished business at the Basel Committee, I'm keen that we should aim for a period of greater regulatory stability ahead. Businesses need that certainty in order to be able to plan and to invest. This approach, by the way, fits into the Commission's broader objective of regulating better and regulating less. This year, we will propose 80% fewer laws than was usual each year under the last Commission. And we're reviewing 2.5 times as much legislation as in previous years to check whether it's working as intended. In my own area of financial services, like ANDREA, I want us to keep the rules as simple as possible. The more complex they are, I think the more you risk opening up a regulatory arms race, and it can make it harder for managers to take responsibility, which to my mind should be one of our ultimate policy goals. For me, part of good lawmaking is that you have rules that command respect. That means they need to be proportionate, they need to be related to risk, and drawn up in a way that reflects different business models and different sizes. And in striving for financial stability, we also need to remember that lack of growth is now one of the biggest threats we face to financial stability. So I'm keen that we should apply rules in a way that takes account of their implications for European business. That's the approach to legislation that we'll be bringing forward this year to implement the total loss-absorbing capacity requirement. It's also how I'll be approaching issues like the net stable funding ratio, the NSFR, and the leverage ratio. We've asked for the EBA's advice on both, and we're now preparing the ground for preliminary discussions with Member States and the European Parliament. On the basis of these discussions, we'll come forward with a proposal by the end of the year on how to apply these rules in a way that makes sense for Europe. At the same time, I've argued that we also need to check that the legislation that we've already passed is as growth-friendly as possible. And that's the thinking that lies behind the cumulative impact assessment of the financial services legislation, what we're calling the call for evidence, that I launched last year as part of my work to build the Capital Markets Union. In recent years, we had to legislate at speed to get the crisis under control. And during that time, we introduced 40 separate pieces of legislation in Europe. I'm quite clear that that has made the overall architecture stronger. But when you're firefighting, when you're in the heat of the crisis, it's impossible to get everything right. Nor is it possible, I think, to predict exactly how the rules will interact once they're up and running. So now, as we work to create an environment that supports investment, we do need to check that taken together, those rules haven't had any unintended consequences. This call for evidence ended on Monday. We've had nearly 300 responses from 20 member states and a few as well from outside the EU. We've had responses from right across the industry, from 26 public authorities, and from the people who use financial services. Some of the concerns that have been raised are about rules getting in the way of the diversity of the EU financial sector, compliance burdens linked to the duplication of reporting requirements, and unintended consequences like the impact of the rules on lending and market liquidity. So we're now reviewing the responses, weighing up the evidence before deciding whether change is needed and how we should go about it. We'll be discussing this with the European Parliament and Council soon, and we'll set out our analysis on the way forward before the summer. As part of a separate exercise, we're carrying out a review specific to the Capital Requirements Regulation, the CRR. For me, we need to make sure that this regulation and its sister directive, the CRD4, achieves its prudential objective while imposing the lowest possible administrative burden so that banks can get on with their job of lending to the economy. So here I want us to look at how we can simplify reporting requirements and costs that are associated with compliance more generally. I want to know whether we can tighten legislation up, whether we can correct some technical mistakes and give more certainty to businesses. I'd like us to be able to take a more proportionate approach to smaller banks and take a close look at whether it really makes sense to have the same compliance requirements for all banks and all business models. To encourage investment in infrastructure, I want to look at whether lower capital requirements, like the ones that we already apply to SME lending, and a better recognition of the risk associated with infrastructure projects could play a part in improving long-term investment. Here we've sought external advice and we've asked London Economics to provide us with some analysis. And for lending to SMEs, I want to check that the thresholds under which loans can qualify for lower capital requirements are set at a high enough level. Another area that we need to look at as part of the CRR review is additional Pillar 2 requirements. We know that there are differences in how these rules are applied by supervisors, so I think we need to make the rules clearer so that the legislation can work as was originally intended. There needs to be a clear difference between the goals of Pillar 1 requirements that apply to all banks and Pillar 2 requirements that are bank-specific and depend on the level of additional risk that banks bear. And this will help us meet our goal of preserving financial stability and also supporting banks' competitiveness. We'll present our recommendations on this and other areas being considered under the CRR review later this year. As we take forward our work to make sure that we have a legislative framework that supports growth in all 28 member states, we're also working to strengthen the banking union. At the end of last year, we came forward with a proposal to put in place a European Deposit Insurance Scheme, or EDIS, by 2024 as part of a broader plan to deepen economic and monetary union. Put at its simplest, it aims to give the banking union the third leg that was always intended, alongside the single supervisor and the single resolution authority. The plan is to move from a single system of deposit guarantee schemes to a scheme that will underwrite deposits across the whole banking union. Depositors already have the confidence of knowing that their deposits are guaranteed up to €100,000 if their bank goes bust. EDIS is a banking union-wide scheme that would make banks better protected if there were larger local shocks. We want to build it up gradually until it's fully mutualised by 2024, and the same level of protection will apply to depositors throughout. It should be cost neutral for the banks because contributions to EDIS would be deducted from what banks pay in to their national deposit guarantee scheme. And we'd also need to put in place strong safeguards against moral hazard. Alongside that proposal, we're driving forward a whole range of measures to reduce risk. We'll start by keeping up the pressure for the full application of all the legislation that has already been agreed. The new resolution framework needs to be properly incorporated into national legislation, and the Deposit Guarantee Scheme Directive also has to be fully transposed. We're going to consult on the key differences between insolvency and early restructuring regimes across the EU. By the end of this year, we'll bring forward legislation to address the most important barriers to the free flow of capital, building on national regimes that work well. We'll also continue our work on national options and discretions. While some are there for a good reason and are used to take account of specific circumstances in different countries, supervisors need to be able to compare apples with apples. So it's important that we avoid differences in rules that stand in the way of competition and trade across the single market. So despite some of these challenges that we still face, I'm in no doubt that the European banking sector is much stronger today than it was before the EBA was born 5 years ago. As we look to finish the work that was set in hand in response to the crisis, I will continue to seek to strengthen financial stability, and in doing so, I will always ask myself the following questions. Are we regulating in as growth-friendly a way as possible? Is what we are proposing proportionate? Have we considered the effects of what we're doing on the marketplace? I want to strike a balance that keeps banks safe, but also sees them return to the mainstream of our economy and of our society. For that to happen, I know that banks themselves recognize they have an obligation to act responsibly, to provide a lead, and to drive forward further improvements in conduct and behavior. But I am sure that by working together, the banks, the supervisors, the regulators, we can keep our banking sector strong, we can reduce risk, but also support the investment and growth that Europe needs. And in that task, I know that the EBA will have a vital part to play. And I'm sure that in the years ahead, it will play it with the same professionalism and the same dedication that it has shown over the last 5 years. Thank you.
Ladies and gentlemen, we are ready to start with our first panel. I would now like to invite the moderator, Adam Farkas, Executive Director of the EBA, and our panelists to take their seats on stage now. While they take their seats, let me just give you some information on this panel discussion, which is entitled 5 Years of Common EU Standards and Policies in Banking. The panelists will debate the progress made in the repair of the EU banking sector over the past 5 years. From regulatory changes to adjustments in EU banks' balance sheets, we invite our panelists to share their views on the effectiveness of the measures taken, but also the impacts of the new regulatory framework and how EU banks have adapted their business models to the new rules. The debate will be followed by a question and answer session, and the moderator will let us know when the time for questions has arrived. As said, please do raise your hands if you have a question, and our staff will be carrying around microphones. Those watching the event on the EBA website are also welcome to submit their questions throughout to the EBA's Twitter account, which is @EBA_news. So I will now pass the floor on to the moderator, who will introduce you to the panelists.
Thank you. Thank you very much, Katrine. Ladies and gentlemen, on the occasion of the 5th anniversary of the EBA, we, within the EBA, are also having a lot of reflections on what we have achieved, what we could have done differently, what we could have done better, how our work is impacting the financial system, and how it benefits the wider public at large. But these internal reflections with our colleagues would not be complete without listening to some of the key participants, key players in the financial system, and also a wider range of our stakeholders on what they think about the EBA's first 5 years. Therefore, we invited a very distinguished set of speakers today to share their thoughts with us on these very, very interesting questions. And it is my pleasure and honor to introduce the panel. I don't think panelists need a lot of introduction, so I will keep the introductions very, very short so that we can have much more time for the discussions. First, I'd like to introduce Danielle Neuilly, who is the chair of the Board of Supervisors of the SSM at the European Central Bank. And we are very proud and honored that you accepted the invitation and will speak to us. And then I will introduce the panelists from the left to the right. David Llewellyn, who is a professor of money and banking at the Loughborough University, and also in his part-time, he has been with us and acting as the chair of our banking stakeholder group throughout the last year, so he's very intimately involved in the EBA's affairs. The next panelist is, to his right, is Martin Helwig, who is the director of the Max Planck Institute, and he's a distinguished speaker of various conferences, and he has been also involved in the European system of financial supervisors in his academic capacity at the SRB. Next panelist is Mario Nava, one of our founding fathers at the Commission. He's the Director of Regulation and Prudential Supervision at DG FISMA, formerly DG Markt, and we are also very glad that he's with us. On the right of Danielle, we have Jamie Caruana, who is the General Manager of the Bank for International Settlements. And he's bringing us a global perspective to these questions with the extensive analysis and research the BIS is conducting, and also being in the center of the global regulatory developments. On his right, we have Frédéric Oudéa, who is currently chairing or the president of the European Banking Federation, and in his full-time capacity, he's at the helm of a global systemically important bank, Société Générale, so he's bringing a lot of experience on how our work is impacting the financial system and whether we are doing a good job or not. And to my left, we have Gerhard Hoffmann, who is the member of the National Association of Cooperative Banks in Germany, and he's also serving on the board of the European Association of Cooperative Banks in Brussels. So I would like to again thank you for accepting our invitation. And what I will try to do is ask a few questions to ignite a discussions. We are expecting some differences of views, hopefully, some interaction between the panelists, and then at the end of the discussions we will open up the floor for questions from the audience. And one little bit of housekeeping: if you look at the program, you might realize that we are late with the timeline, but I can promise that we will not adhere to the traditions of the EBA board meetings where we never have coffee breaks. We will respect the coffee breaks, which is in the program, even if with a little bit of delay. So on that note, I hope it gives comfort to all of us. On that note, I would like to ask the first question to Mario and Martin. And the question will relate to some of the statements we heard in the opening speeches. And I would like to ask you, how successful do you think the post-crisis regulatory and supervisory reform has been in Europe? Are EU banks really stronger and more resilient? Have we achieved the objectives of the repair in the EU? What are your thoughts on this? I start with Mario.
Okay. Good morning, everybody, and thank you very much for the invitation. It's a great honor to be here with you after 5 years of hard work, I think. all the previous speakers have recalled how not easy it was, but passionating. My view on this point, is the banking system stronger or not, I think is very clear, is that definitely the banking system is stronger. Definitely, no matter how you measure it, the amount of equity in the system, that you measure it as a risk-weighted indicator, that you measure it as leverage ratio, no matter how it is, substantially increased. When you look at the asset quality, there I recall the exercise of the SSM 15 months ago, and the recent EBA exercise, when you look at the asset quality also, that it has increased. So I would say systemically and generally, the bank system is much better. Clearly, the fact that you have solved the systemic issue doesn't mean that idiosyncratically everything is okay. But there again, I think the contribution of EBA is quite evident, because EBA has brought transparency into the idiosyncratic issues. And then I just recall the EBA transparency report of 6-7 weeks ago. And in that report was quite evident what were the remaining issues. The other reasons why I think the IBA has made a significant job in making the system stronger is what Andrea hinted to in his introductory speech. Is not only an issue of bank capital requirements, it's also an issue of other rules for other things, like take the payment service directive and all the guidelines that are attached to it. So I believe, yes, the system is stronger. Yes, there are rules that make the system more responsible. I'm sure Elke Koenig later on will take the occasion to talk about bail-in and bail-out. This is clearly a system of rules that make the system stronger. So overall, the reply to your question is, yes, I think it's stronger, and where is not stronger, where still there are problems, it's very evident what there are. So we know what we need to do to solve it.
Thank you, Mario. Martin, what do you think?
I agree that the system is safer, but safer is not the same as sufficiently safe. If you have a truck with explosives getting into trouble at 150 km/h in a densely settled area, and you lower the speed limit to 140, it's safer, but still not acceptable. I also think we are not out of the woods yet. The cleanup has been insufficient. Italy has just provided us with a reminder of that. The need to put 200 billion into a bad bank, provide guarantees of 200 billion for a bad bank, suggests, well, that there may still be skeletons in the closet, which to me raises the question of, how did the asset quality review deal with those dubious loans? If we look at the economies all around, governments, non-financial companies, private households, we still have a lot of debt. And in all the discussions about lending and growth, we should take account of that. If there is too much debt around outside the financial sector, just asking the financial sector to lend more may not be the solution. It's just like if you have someone who's suffering from a withdrawal of alcohol, and you then say, okay, give him another bottle, that will make him feel better. It's not the cure. We need to face the problem, the fact that the real economy is weak, and that, of course, has repercussions for the banking sector. The banking sector itself is lacking profitability. There are two factors behind that. Well, leftovers, write-offs, but more structurally, large capacities, technologies which involve significant fixed costs and not very variable marginal costs, and therefore make it difficult to earn rents in competition. And then a lack of exit. If you bail everybody out, you don't solve excess capacity problems. On resolution, I have yet to believe that it will work. The discussion about single point of entry, multiple point of entry, raises very serious political questions. I'm quite sure that there are many countries that would not agree to single point of entry resolution when it concerns lending in their own country. So I appreciate that in particular the Bank of England and the FSB, on the initiative of the Bank of England, is moving towards single point of entry as something that would make cross-border resolution work. I don't think it's politically viable. None of the European legal norms says anything about provision of liquidity in resolution. If money market funds withdraw money, who's going to step in? Central banks? In the Greek episode, we had a discussion about central bank lending to banks of dubious solvency. So that's an unsettled area. Returning to the financial sector as a whole, the dependence of the financial system of banks on money markets, in particular sort of short-term wholesale funding, in particular from money market funds, is still very substantial. That played a major role in the post-Lehman crisis. It also played a major role in the 2011 European crisis. Money market funds, of course, are regulatory arbitrage incorporated. And the US authorities, with their fragmentation of authority between the Fed, which is in charge of prudential supervision, and the SEC, which sees its task as investor protection, that fragmentation has not been reduced and remains a major systemic risk as such. On equity, 2 points. Martin Wolf responded to Basel III. If you triple something that's close to zero, you still don't get very much. On leverage ratios, the ratios that we've seen have moved from something like 2 to 5% to an interval of 3 to 8%. Those are still low numbers. And we have to appreciate that accounting rules provide banks with opportunities to have lots of risks which don't even appear on their books. The Deutsche Bank Montepaschi di Siena transaction provides an example. So I'm a bit worried that we haven't really done very much, and that the discussion right now, as we could hear in both the introductory remarks of the Lord Mayor and in the talk, the keynote lecture by Commissioner Hill, goes in the direction of what does all this do to lending and growth? Now, I've never heard in all the discussion about regulation a precise discussion of what are the market failures we are addressing and what are the social costs. With due respect, it's not just a question of the customers. It's also a question of the overall economy and the taxpayers. And to the extent that excessive borrowing of the financial sector is due to borrowing being cheap because there is a taxpayer behind it who will subsidize it if necessary, then that's a social cost that needs to be taken into account.
Thank you very much for the two initial interventions. I think we already have a lot of food for discussion and thoughts. Let me ask the other panelists if anybody would like to reflect on these two interventions a little bit, or should we move to the next question?
Well,
Danielle.
yes, gladly, because you offer me the opportunity. I would like to say that there is no skeleton in the cupboard after the comprehensive assessment regarding non-performing exposures. In fact, EBA did something incredibly good, which was to give us a common definition of non-performing exposures. That was used during the asset quality review of the comprehensive assessment. So this allowed us to identify in a strong fashion the non-performing exposures. Then the asset quality review permitted to get them covered properly with provision when to the extent needed. And obviously, after the comprehensive assessment, supervisors, the SSM, sent on-site missions to look at the 40% about that had not been reviewed, 40% of assets through the comprehensive assessment, because the comprehensive assessment and asset quality review was reviewing more than 60%, 62% of assets. But when the findings of the asset quality review were significant, we sent on-site missions to the banks to see what was the situation of the 40 more or less remaining ones. So this is done, identification, provisioning. So no skeleton in the placards, maybe skeletons, but not in the cupboards. And now we are addressing the long journey of fixing the issue of non-performing exposures. We have a strong working group chaired by a dynamic lady from a country that has done very well in addressing this issue, which is good to have to take care of this group. And we are step by step, but with momentum and commitment, addressing the issue. It goes beyond supervision. In certain countries, you need to have proper laws that permit repossession of collateral. Once you have the law, you need to recruit the judges, and so on and so forth. But this is a long journey that has started firmly, and that will deliver, and in fact is already delivering a lot of fruits.
Thank you. Any other? Yeah, please.
I would agree and disagree at the same time with the statements made. I think it's absolutely correct that we have to think about what are the true market failures to address. And is our approach targeted enough or sufficiently targeted? And I would even add, are there regulatory failures which need to be addressed? I mean, if you create a huge amount of rules, complicated, very fast, and could this result even in a regulatory failure at some point in time? Is complexity becoming a new risk? At the same time, I must say I very much liked Commissioner Hill's speech, who put the overall framework, the regulation, in a totally new perspective. I think it is important to have this broader perspective. Europe, I don't think, has a problem with not enough rules. Europe has a problem with growth, with innovation, with competitiveness, and I think this cannot be obviously the primary targets, but they have to be taken much more into account when we regulate. And I liked everything he said, apart from his remarks to Edis, where we know we have a different opinion. But it's important that the Commission enters into this new kind of policy that I think is absolutely right to go down this road.
Thank you very much. Let me, I think we will come back to a number of the points during the discussions later, and I think we should never forget them because there are a number of reflections that could be made on the points raised by Mario and Martin. But let me move on slightly and selfishly, because I would like to ask a question about the EBA in the next round. So how would you describe the EBA's role or contribution to this repair process, which we understand has gone very far, but it's not necessarily finished and completed. And what do you think we have achieved, and what we could have done better? I'm also interested in the views on our activities, and not only the number of rules, which I understand is already noted, but could we have done differently or better? I would like to ask Danielle, who was, of course, following very closely what the EBA has been doing in the last 5 years, and then I will ask Gerhard as well, and of course then open up to other comments from the panelists.
Well, thank you, Adam. I will start by saying that EBA was not starting from scratch. Even before the crisis, obviously after the crisis, there were initiatives taken. L'Enfant-Lucie reform, CEPS, the single rule book of Tommaso Padoa-Schioppa, because he is the person that put this concept on the table. So there was already, we were already on the path to further convergence. Obviously, with the financial crisis, an extraordinary momentum to the convergence process was given. The EU legislator established EBA on other European supervisory authorities, and that was very important to foster regulatory and supervisory convergence. And as I mentioned already, two very important elements for me, the single rule book and allowing the ECB SSM to get started. We have found this very large amount of binding technical standards, guidelines. We have so much to do with supervision. We are so happy to find the regulatory, the standards, the guidelines ready to be used. And the particular example, which is important for me, is this piece of on non-performing exposure, the definition, as I mentioned. This is what permits us to have a good comprehensive assessment. Also, EBA had other ways of helping us. The transparency exercise that have been conducted, and which are of particular importance the year without a stress test. I think as well all the work which is being done right now about recovery and resolution, the fact that there is now an EBA committee to fully prepare recovery and resolution directive implementation. We are all looking forward to receiving the report on MRL. That will be something important to fully understand this complex world where it has to go in parallel with TLAC, almost the same concept, but for global CFIs. We should not forget either the work which is done regarding consumer protection, and this is a very important issue. Because with the directive BRRD, we are entering in a different world for consumer protection. Commissioner Hill stressed the fact that no more taxpayer money will be put to save the banks, bail out the banks. But sometimes the consumers and the taxpayer money are just the same people. And taxpayer money were used to pay for bailing out banks. Let's make sure that consumers, retailers, which are holding the liabilities of the banks, fully understand their new situation and their new role. So I think all these activities of EBA have been crucial to help building the new environment. I'm pretty sure that there are still challenges, there are still improvements that can take place. This is true for SSM as well, of course, and we are even younger, so even more room for improvement. And I'm quite happy to have the EBA to help me in this supervisory work.
Thank you, Danielle. Gerhard.
Yeah, I would like to start with the people, because EBA is all about people. And I'd like to state that EBA has gained a huge and very positive reputation, acceptance, not just in the industry, but way beyond, due to the highly skilled people, to the management, to the staff, but also to the national competent supervisors. I think which is extremely important, because if you have an institutions which doesn't have the public and industry acceptance, you cannot operate in a safe and convincing manner. Also, EBA has proved to be a high-speed train, I would argue. We have heard from ANDREA and ENRIA this morning that they have issued 160 standards and guidelines. I mean, this is an amazing number. And I've just asked my colleagues when we had coffee this morning whether there was any one standard which stood out and was a failure or was totally flawed, and they couldn't come up with one single example. So I mean, this proves that it's not just highly skilled people, but also high quality work on EBA, and I like to say this on this fifth anniversary. I think that's an honest compliment. On the substance, we know that EBA does not work in an isolated manner, but EBA is part of a whole regulatory framework, of a whole policy framework, of a whole legislative and implementing framework. Insofar, what I'm going to say now is not only and purely targeted to EBA, because I have some critical remarks too. And the remarks refer to diversity. And this concept of diversity was even mentioned by Jonathan Hill. I'm a bit surprised, I must say, that diversity is not appreciated more in the financial sector. We have world leaders in the corporate world who are striving for diversity because they think diversity for a company or for an industry is a huge advantage. And it seems to me that if you argue with diversity, and diversity, I must say, and that's my next concept, is linked to proportionality, we have always to defend ourselves, because this is in a way not fully incorporated. And I totally understand if you have this fast-moving train, have to produce results quickly, you may be inclined to take less care about these other impacts. So, as I said, diversity is linked to proportionality, and I think there we have really something more to do. That's maybe on the process a not totally satisfactory area. And this is because I think it's the concept of technical issues is sometimes, I should say, used as a way to form a compromise on level 1 or level 2. Whenever in Brussels you have an issue which is difficult to resolve, there's a tendency to delegate, in a way, this issue to the ESAs, to EBA, to IOPA, and to ESMA. I think we must be very careful about this, because then there's a danger that the ESAs are coming into a role of the legislator, which is ultimately not controlled by the European government structure. And also on the substance of proportionality, we have often encountered the argument, well, we cannot totally exempt some small and medium-sized banks or banks with a very simple business model because the regulation doesn't permit us to do so. So therefore my suggestion in this area would be that we are much more careful on the level 1, level 2 legislation to put in clear leeway and boundaries for the use of proportionality and to make proportionality work in practice. The perception on the part of the industry from small and medium-sized banks is more that proportionality is the icing on the cake. It's the last 5 to 10% of a regulation, but it's not really recognizing the specificities of an industry. And therefore, I mean, it would be a good thing that we had more attention already on level 1 to have very clear rules. And as I see Burkhard Balz, the Member of Parliament of the European Parliament here in the room, I must mention his proposal also. He is proposing a proportionality report. And obviously we would highly appreciate that, let's say, after 1 or 2 years, a recurring report would be drawn up by the Commission and by the ESAs, whether we have really hit the target on proportionality. Thank you.
Thank you very much. I think the messages were loud and clear, both positive and the suggestions for improvement. I can see that David maybe would like to make a comment or jump into this discussion.
Yes, could I make a general comment first? To set EBA in perspective, we have been through probably the biggest banking financial crisis in history. And that has actually led to one of the biggest ever changes in the regulatory regime in a relatively short period of 5 years or so. I cannot look back in history and find any other time when such big changes have occurred simultaneously at the same time. And in effect, it is also a new approach, because what the new regulatory regime is doing is not only attempting to reduce the probability of bank failure. That has always been one of the objectives of regulation. But I think the new part of the regime is, in fact, to also reduce the social costs of those bank failures that do occur. It is very easy to reduce the probability of bank failure to zero. Capital ratios of 50% or whatever, that will do it. You'll have a perfectly safe banking system and you'll have a perfectly useless banking system, but it can be done. So it seems to me that we have to accept that there will always be a probability greater than zero that banks will fail. And therefore the second strand in the European Commission's and EBA's approach to reduce the social costs of those bank failures that do occur is a very important part of the regime. Having said that, if I may say so, BSG has recently published a report on proportionality, and we argued that perhaps there is time now to take stock, and in particular what we are concerned about is two aspects. Not that the overall regime is too tough, that wasn't what we were trying to look at. One, that it has become too complex. And we do stress that we're talking about excess complexity. If the financial system is complex, regulation has to be complex. We're not arguing that. What we're arguing is whether in fact it has become unnecessarily complex, and whether in fact the same objectives could be achieved more effectively and efficiently by a less complex system. We're also concerned about differentiation, which is what Gerhard, you were talking about, but we may come back to that later in the discussion.
Thank you. Thank you very much. I think it was this discussion was also touching some very important and sensitive issues. Let me now move on to another, I would say, I think, fascinating question and interesting topic, and Martin alluded to that already when he was talking about resolution strategies in general. But this is coming to the root of the of one experience or consequence of this financial crisis, which was fragmentation. The reaction of the financial system to the crisis events was an increase of fragmentation and the reversal of some of the processes that led to global integration and the deep integration within Europe. So my question, my next question would be relating to an assessment of this crisis response or the repair process. How much this repair has managed to restore the integrity of the EU single market in financial services? How much have we succeeded in countering the fragmentation which we experienced? And I would like to ask Jamie first to put this into a global context, because of course the BIS is in the center, one of the global centers in analyzing this issue, and so you have a global view as well as you have a very detailed and deep knowledge of the EU single market. So I'd like to ask you to comment on this first. And then I will ask Danielle, who is in the center of the measures of reducing fragmentation, of how do you view the progress in this as of today. So please.
Well, thank you very much. And first of all, I would like to congratulate EBA and ANDREA for 5 years of, I would say, excellent work. I know that it is 5 years, but I'm sure that they are feeling like 25 years because it has been the most difficult period of time for everyone, for banks, but also for regulators. And perhaps one of the most difficult tests is this one of fragmentation. And the worst test that you can put on fragmentation is a financial crisis, because immediately after a financial crisis, there is a tendency to come back home, to fragment, to protect, to build ring fences. And if we start by looking at what has happened in the global, which was what you were asking to me, just looking at the statistics, the first reaction immediately after the crisis was that a significant reduction in cross-border lending by banks. And it was quite significant. But it was even more significant for EU banks, EU-based banks. And if you look at the EU-based banks, the EU-based banks' exposure to EU, meaning within the region, each one with the rest of the region, declined by more than half. So half of the exposures was reduced. The exposures towards outside of the EU reduced by 30%. So there was an additional element in the EU. And what was the most reduced? It was interbank. Then it was the private sector, and finally the one that suffered the least was the public sector. If you look at, in contrast to the international banking activity outside of the EU banks, what happens was the opposite. In fact, really the banks outside of the Eurozone were increasing their exposure outside of their borders. But all in all, particularly in Europe, there was inward-looking movement in terms of banking. That again was basically not much in the United States, significantly in Europe. Now, what I would like to argue here is one thing, basically. This is part of a complex mechanisms. Not all I would call fragmentation. It is also transformation in the financial system. It is also a new assessment of risks. It is also some kind of necessary deleveraging because probably the bank was delevered. So it's a mixture of a number of things. But certainly part of it, and I'm not sure how much is that, is some kind of unnecessary and dangerous fragmentation, and we should be always looking for policies and measures to reduce this fragmentation. Frankly speaking, I think the reaction, in particular by all regulators and by committees, and certainly and particularly in the case that we are talking today by EBA, had been extremely important and extremely efficient. I think that in this kind of crisis, without this reaction, we would have a hugely fragmented market. And I think it has been difficult, but thanks to this work, there has been a significant reduction in the potential fragmentation. We know that we have seen very, very serious episodes of fragmentation in Europe, and some of them were related to the risk of redenomination and other risks that are very particular of the Eurozone. I think that EBA has been a key player, and some of the elements have been mentioned. Just having a common language, a common definition, etc., helps enormously to reduce this fragmentation. I would like to say that there are challenges still ahead, so the work has not been completed. There are challenges. I would mention, because everybody has mentioned, and I think it's important, that the financial stability, cleaning up all the non-performing loans, etc., is part of creating a more united and less fragmented market. But I would like to go back to the single rule book, which I think is very important, from my perspective is still incomplete, and there is excessive local discretion, and I think it would be good that the work continues. I frankly speaking, I think there is a possibility to do both things, to have the necessary diversity and at the same time having a single rule book. I think it's good to have diverse strategies, but I don't think it would be good to have diverse definitions of non-performing loans. I think that's not what it would be helpful. So I think there is enormous capacity to being a little bit more, do more work on this single rule book, and I think EBA is doing a great job. I also am in favor of proportionality, but proportionality to what? And I would be more in favor of proportionality to risks. And sometimes size is not risks. And I'm coming from a country who was more affected? Not the largest, but the smallest. So you need to look at risks, and the proportionality should be more on risks and not just on size. And so my third challenge, I think, is that there is still an issue. I know it's very sensitive, but part of the fragmentation has been the relationship between banks and sovereigns, and this remains an issue that needs to be addressed at some point of time. And I think I would say that these are important challenges ahead of EBA and ahead of all of us. I would stop.
Thank you very much. Danielle?
Indeed, after the crisis, fragmentation was terrible and a lot had to be done. And rightfully so, in my view, it started by institutional and regulatory reforms. Institutional reforms are important. Andrea mentioned a moment ago that we were trying to do already, both of us, as a matter of fact, together at a certain moment of steps, a lot without real powers, really. Moral suasion was what we had. So now the agencies, the EBA has received adequate power, and this makes a big difference. We need the regulation as well, and this has been done. And I fully support what Jaime said about proportionality according to risk. That's very important. Let's take a factual element. When we started the SSM, the number of banks that were in the SSM under program approved by the European Commission, most of them were medium size or small size. Of course, they got a lot of attention. These banks, a lot of support as well to make sure that they emerge from this program in good shape. I believe that a lot has already been done, and we see the fruits in terms of fragmentation. We prepare a report with the European Commission on financial integration in Europe that will be published in April, like other years. And if I try to look at a little bit what we can see in the preparation, fragmentation in financing conditions and deposit rates have been reduced since the financial crisis and the sovereign crisis. In addition, both bank borrowing costs for both firms and households have declined considerably. The dispersion of bank borrowing costs paid by non-financial corporations in the euro area countries has narrowed. Still, the quantity of cross-border banking activities has not improved much and remains at low levels. So overall, there are positive signals. We are moving in the right direction, but there is still more work to be done. And maybe it's not a surprise because, for example, among the challenges, banking union is still incomplete. The SSM and the SRM meant a quantum leap for enhanced integration. But we still have to move regarding deposit guarantee schemes, EDIS, the missing third pillar of the banking union. We also still need to agree on a public backstop for the single resolution fund. Also, in the regulation, the national options, we did already a lot. Out of the 167 we identified, we managed to harmonize in a rigorous fashion 122 or 3 so far, but there are the remaining ones, and most of the remaining ones are in the hands of the legislators, and not all of them are insignificant. So something still to be done. And we also should develop this common market union, the capital market union. This has also the potential to reduce fragmentation quite significantly, and that would help the growth in our economies at the moment, or certain banks still have to deleverage. Thank you.
Thank you very much. I think it's very clear, judging from your comments, that we are in this process. We have managed to reverse the fragmentation trend, but we have a long way to go to really talk about a fully integrated single market, as well as the same for a global setting. But I could see Mario wanted to intervene very briefly.
Talking about single market, of course, I couldn't resist intervening, and I want to reinforce what both Jaime and Daniel said. I mean, fighting fragmentation, if I may use the dramatic language, fighting fragmentation is probably the most important economic action that one has to do. It has to do with economy. It doesn't have to do with ideology, integration, or things like that. No, it's essentially an economic thing, because what spurred growth was the single market. Fragmentation means the end of the single market. There is not the biggest economic danger than the end of the engine of growth. That's what I think my commissioner said very clearly. Lack of growth, and even Martin concurred, the lack of growth and lack of profitability of banks is the biggest danger to financial stability. So I think the fight of fragmentation, where I think, and you will see it in the April's report that Daniel was mentioning, I think we have made strides, but it's something that we really need to continue doing in the next many years of activity.
Thank you. Martin? No. Okay. Please.
I think the fragmentation problem is unsolvable as long as the relation between member state governments, central banks, and banks in a given jurisdiction is not really clear. If you think about what happened in Greece, why was there a run on Greek banks a year ago? That had a lot to do with the notion that a euro bill under your mattress might be safer than the same amount of money in a bank account if there was a threat that the government might impose on the money in the bank account in ways that it couldn't impose on the money underneath the mattress. And as long as we have that issue, that banks are not really supranational, as the monetary authority and the supervisory authority are, we won't get out of this fragmentation.
Thank you. I think it's been mentioned that this issue of the link between banks and the respective sovereigns is on the table. As we all know, it is under discussion. So this topic is being addressed. Of course, it's one of the most sensitive ones, but it is being discussed and addressed globally as well as within Europe. But let us hear now the bankers. As well, we have talked about a lot of policy points, policy issues, objectives and achievements. But let's see how the industry experienced this repair process from their angle. How do you see the process of the creation of the single rulebook and its impact, and how do you see the achievements in supervisory consistency in Europe in this general repair process and trying to restore the integrity of the single market. So I will first ask Frédéric to have some comments on this question, and then we will turn to a very different business model, as we know, but of course with a very different impact. So Frédéric, please.
Yes, first of all, good morning, and may I say on behalf of the EBF, happy birthday to the EBA, and thanks for the hard work. I guess I'm here effectively to speak as may I say, the representative, one of the representatives of the industry, a practitioner. I always, if I may say so, and with a lot of friendship, feel a little bit also like the representative of a sick community. The doctors have spoken, and now I have to say, how do I feel? Well, I don't feel that bad, but may I say, I can tell you there is more going forward, and so I would like to ensure that the amount of treatments will mean I will be even better in 5 year time. First of all, can I just say, on all these matters, the EBF clearly supports the idea of a more integrated financial market in Europe, of something which will not be balkanized, fragmented, because, and I will come back to that, when I think about the industrial challenges we have to meet to serve our clients, I would like to see a wider market, a more integrated market, to avoid the cost of this fragmentation when we have to pay so much, and when I say this in particular in the Eurozone, to build the banking union. So clearly, may I say, we support that effort. Can I just say also, and a lot has been said, and I fully agree with David, I think we should not underestimate the magnitude of the changes of the rules. I've been in the banking industry for more than 20 years, and when I was young, I was told that there was a certain role for central banks, which was to provide fundamentally liquidity to save banks in a case of crisis. And I was told that the role was to transform short-term liability in long-term loans. Well, can I just say on these two examples, I think now the rule is totally different. We are told basically to get on without any kind of support from the central bank, hence the liquidity rules. And the transformation is now an anti-transformation. To a certain extent, assets getting shorter than liabilities. These are just examples to show the magnitude of the change. And that concerns, as it has been said, capital ratios, liquidity ratios, resolution mechanisms, and I think it will be an important part of 2016, and what is important is to check that it does not recreate fragmentation. It is about client protection, and it's very important, as mentioned by Daniel Nui, but it's also about governance of banks. You have here a medical scientific medical miracle. I have been split in two parts. I was chairman and CEO of Société Générale, and I've survived into a big surgery where we split the role. So, I mean, these kind of things have changed, and beyond this, the magnitude of the rules on governance is absolutely enormous. So a lot has been done. May I say still, unfortunately, a lot has to be done further, because beyond, I think, defining the rules, we see that there has been still some different interpretations. And the Commissioner just mentioned, for example, the need to clarify the rule on Pillar 2. These are, of course, critical elements for us going forward, and we've seen just recently that with these Pillar 2 and MDA things, there had been in Europe different interpretations, so that needs to be clarified. And after that, it has been mentioned also that there will be a big job to harmonize, for example, the calculation of risk-weighted asset beyond the rules, things like this. So I can see still 3, 4, 5 years of heavy workload, heavy implementation, and of course we are just at the beginning of digesting all these rules. I think what is important, yes, the rules have been defined, but at the end of the day we have not seen all the consequences of these rules. Jaime mentioned, of course, the first consequences of a refocusing of the banking sector, with perhaps sometimes less cross-border exposure, but I think more is going forward. And I would like to finish on this, because at the end of the day, I think we neglect a fundamental thing, which is that we talk about all these changes of regulation, while at the same time the industry is facing two other major challenges. The first time is the interest rate environment. To have low rates, sometimes negative, and a flat curve is a game changer for the banking industry, or at least the traditional one, which is about lending. If it lasts for long, it will have strategic consequences. The second one is, of course, the emergence of digital technologies. And digital technology will be, in my view, disruptive, probably not immediately, but in the midterm and long term, in particular on the retail side. And we are, I think, living an extraordinary moment, because there is a cocktail of these three things happening. A revolution on the regulatory framework, an extraordinary interest rate environment, and second, the emergence of these digital technologies. That means an extraordinary challenge for bank managers. And I must say, when I think about stability, beyond, may I say, the fact that certainly in certain banks, in certain countries, there are still the legacy of the crisis, some NPL and things like this. But this equation, I think, is much more complex for the industry, of course, itself, but for the economy. And at the end of the day, I can just tell you that today, as a CEO also of bank, knowing whether and how I can invest an additional euro of capital is a big question mark in an environment which is uncertain from many angles. And when we land on a 5-7 year horizon. It's not just 3 years. So I think this is now should be the focus of regulators, of supervisors. Try to think also strategically about the banking sector going forward. Last point, and I have to mention it, of course, here in the city, there is, of course, an elephant in the room when we think about single rule book. It's about the Brexit, whether, of course, the UK stays or not. That can be, of course, an issue.
Thank you very much. Very wide set of comments with a lot of possibilities for reflection. But Gerhard, before we open.
I have been listening very carefully to Frederick's remark and trying to find out whether he, as a representative of a large bank, and me, more like small, medium-sized banks, have any differences in opinion, but I couldn't find one. I must say that's exactly the issues we are dealing with, and I've especially noted two sentences you made. That the magnitude of rules is enormous. I mean, everybody would agree on this, and it will take 3 to 5 years of heavy workload. I mean, that's everything we discuss day and night, I would say. But on the single rule book more specifically, let me make some remarks here. I would argue that we have made major progress. At the same time, this is kind of moving target, because the industry is changing and regulation is changing, and even the perception may change on what single really means. And therefore, these are obviously preliminary remarks. In my opinion, single must not mean 100% uniformity. That would be a total misunderstanding, to strive for 100% uniformity, because I see tendencies in the markets where we have some concerns that we are moving a little bit too fast, and if you move too fast in this direction of the single rule book, changes might be disruptive, not transformative in a smooth way, but can be disruptive. And same rules may be highly efficient from a supervisory point of view, but the same rules, same regulatory framework might lead to the same decisions in banks. And this again might lead to common behavior, to even herding behavior. And that's again the point about diversity. When we talk about the single rule book, you must find the right balance between diversity and the single rule book. Both have merits in themselves, and obviously the single rule book is an important achievement and should be pursued, but we should not create a rule book which actually leads to herding behavior. And also, I would argue about details and complexity. I think that's a point Frederick has not made, but I'm going to make this. It's always a question, do we find the right balance about, let's say, more general principles and giving some leeway to the banks to operate within their environment, or are we building a framework which actually removes the decision-making, the room for decision-making to a very narrow range, and then we are wondering ourselves, we are wondering whether banking business can still work, whether we can fund long-term, for example, or whether it's not, so to speak, contradictory messages we get. And I think these are my remarks to that point. Ultimately, I would like to see, or I would, if I had a wish, I don't know whether we have wishes today, but if I had a wish, I would really speak for having an impact analysis on the remaining open elements of the single rule books. They're saying, are these elements relevant for financial stability and relevant for the level playing field? If they have a high relevance, like let's say the deferred tax assets, that's maybe one example where I absolutely agree, you must have common standards or on the definition of non-performing loans, and that's relatively clear. Then you must harmonize or even implement, enforce a single treatment. But if the relevance for financial stability and level playing field especially is not that high, I would be cautious and move a little bit slower in this direction. Thank you.
Thank you very much. In the interest of time, I will try to combine some questions. We agreed that we would discuss. A related question to our discussion now is what we often hear is that the new regulation, the entire repair, the single rule book, the prudential requirements are actually preventing banks or posing an obstacle to banks to perform their intermediary functions and specifically to provide lending or long-term financing to the economy. And it is, of course, it's a balancing question. So my next question would be, how do you find whether we have found the right balance in the European framework in this respect? And a related question on which we have had a lot of comments already is how the new rules reflect the differences of different business models. And I would specifically ask if there are comments on this business model issue and reflection of diversity, of the identification of areas where specific areas where differentiation could make sense and would be addressing risks rather than necessarily different size or business models. So the question would be, the question I would like to ask is, how does the single rule book and the efforts to increase consistency in regulation and supervision in Europe is supporting the financing of the economy, how well the balance is struck, and what we could do better to reflect the diversity of the business model to different business models to move on in the future. Frederick, would you like to?
Yeah, well, first of all, I'd like just to insist again that strategically, operationally today, it is still unclear. It seems to me unclear to understand exactly how all the different constraints will work. Again, we are facing capital ratios constraints, which are still to be refined with the Pillar 2, the risk-weighted assets. So today it's not that clear to know going forward the amount of capital which has to be allocated to each risk-taking. Second, liquidity ratios, both LCR and SFR, which will have also very clear consequences on certain financing activities or banking activities. The leverage ratio, which is in itself a different element. And, you know, I have a mathematician background. I'm trying to think what is the perfect optimal balance between all this. I have not necessarily find it now. So the problem is, very practically speaking, what we have to do every day is to know, should I allocate more capital there or more capital there? And this answer cannot be clear today. And I think, of course, the sooner we have all the ingredients to at least try to provide the right answer, it's better, because in this uncertainty, it is very complex. And as we've said, the problem also for the sector is that at this stage, the owners of the sector, the shareholders, are not happy with the profitability. And to a certain extent, we have an issue which is probably not now for most banks a solvency issue, but a profitability issue. And I don't know any sector which can survive if it cannot deliver what I would call a decent profitability. Behind this, of course, it's the capacity to attract more capital, to finance investments, as simply as that, at a time where all of us have to finance investment, in particular on the digital technology. So again, the industrial challenge is again very, very complex, and the interest rate situation makes it even more complex. And where I'm worried is that in the next 3 to 4 years, during this period of time, which is so crucial to have effectively more growth and financing, there might be gaps in the financing. Gerhard mentioned infrastructure. We are one of the world champions in infrastructure. I'm not sure about the financing of infrastructure going forward. We will not be able to keep loans for so long in the past, and so it will be very, very complex to finance this kind of assets. I would like also to highlight that I think in this world, in Europe, we need diversified banks. I have no doubt that there is no one business model which works. It depends on the kind of clients you deal with. And whether you deal with individual clients or large corporates, it's very different. Their requirements are different, the nature of banks are different, and you have to have different banks. What is clear to me, nevertheless, is that we have to ensure that we have a competitive European banking sector, because in particular, when we think about financing of the economy moving more towards capital markets, I think we have to have players in Europe able to be part of that transition. Otherwise, there will be more problems also going forward.
Thank you very much. Martin, David, what would you think from your perspective, being academics?
Let's focus this perhaps on the relationship between capital and the business model. The way you pose the question, Adam, have we got the balance right between regulations such as capital regulation and bank lending, presupposes that there is a trade-off between the two. There is an implicit assumption there that if you increase equity ratios, that in a sense is bad.
That's what I heard.
For bank lending. I'm just not at all convinced about that. I'm extremely skeptical about that proposition. Skeptical about the proposition that increasing capital requirements will lead to a significant increase in cost of funding and or reduction in bank lending. I don't think in theory or in the empirical evidence that can really be upheld, at least not in a very powerful way. Of course, as Martin has often pointed out, equity by definition is more expensive than debt, and therefore you would assume that you substitute equity for debt, the average cost of funding is going to go up. Yeah, except that if that leads to a reduction in the risk profile of a bank, then the cost of debt and the cost of equity should fall. It's not at all clear from that where the average cost of funding ends up after the increase in capital ratios. I would also argue that if there was such a powerful effect between regulation and bank lending, there'd be a much greater commonality in experience across the European area. And yet we don't find that. Banks across Europe are subject to the same regulatory regime, and yet the lending experience differs quite substantially. In the UK, admittedly it's to the personal sector, bank lending has been growing quite fast in the last 18 months, at least, I believe. In which case, I think you have to look elsewhere in other European countries for the reason for the weakness in bank lending. Now, having said that, I think there's a very important distinction to be made, and I just wonder whether the bankers who argue the case may not be making this distinction. And that is between what I would like to call the stock adjustment phase and the new steady state phase. I don't think there's any doubt that if you suddenly increase required capital on banks, as you move from, in a sense, relatively low to relatively high equity ratios, you probably will increase the average cost of funding. But that's a transition effect. I would argue that once that transition has been made, that increase in funding costs largely disappears. And in fact, you could well argue, and I think I would argue this, that in the new steady state, in other words, after we've got to the steady state, higher capital requirements, bank lending could be higher than it would have been with a lower capital ratio. The bank could be higher and less volatile. Why? Because there's a bigger cushion. You need less asset sales when a bank gets into difficulty. A lower probability of liquidity runs in a regime of high equity ratios. But above all, a more resilient and stable banking system is likely to be more conducive to bank lending than the opposite. So I think there is a distinction, and when we talk about the impact of regulation on bank lending, I really do think we have to make that distinction between moving from one regime to another, which may be problematic, but that doesn't tell us anything about what the new steady state characteristics will be in the long run once we've achieved that new regime. So overall, I'm a little bit skeptical about the view that's very often expressed that regulation hampers bank lending. My final point, let's remember what the job of regulation is. It's to reduce the probability of bank failures and to create a more systemically stable environment. It has never been the job, in my view, of regulation to support any particular level of bank lending. After all, not all of it is good. And equally, it is not the job of regulation to take a view about what the appropriate balance between capital market and bank funding is to be. And if, and I don't believe it's true, but if there were some negative impact on bank lending, then that may be a good thing, to the extent that some of that business is shifted to the capital market, which might in the end be a more stable structure of the financial system than one when there's a very large focus on banks rather than the capital market. Could it not be, as I would predict, that Europe will actually converge a little bit towards the United States intermediation model, where relatively less role for banks, relatively more role for the capital market? I can see I'm going for the popularity prize here.
Thank you very much, David, for these very interesting comments. And of course, as it is, as you said, it's not the regulator's remit to take a view on certain things. It's not the role of a humble moderator to take a view on a discussion of the panelists. So I will not express a view, but pass the floor to Martin for Hopefully a very short comment, because the coffee is brewing, and then we would like to also allow the audience to pose some questions.
Thank you for having conveyed many of the messages of our book. I'm actually a bit less optimistic, and the reason is that there are private costs to equity which are not social costs. But this goes back to the point: we need to worry about social costs, in particular having to do with the tax deductibility of interest and having to do with debt overhang effects, which make issuing equity less attractive, because many of the benefits go to incumbent creditors. I'm also puzzled in this context about the extent to which the industry is using return on equity as a benchmark for performance and not correcting that benchmark for leverage and risk. There's nothing in what we know about corporate governance which suggests that unadjusted return on equity is a good thing. And choosing that as a benchmark has played a major role in the crisis. The final comment, and this goes back to something that David said before, I'm not convinced that a complex financial system needs complex regulation. We don't have different speed limits for bank CEOs and unemployed people, for doctors and for school teachers. Yet the cost and benefit in terms of time lost due to slow driving differ across these people. We need to worry about what is the externality we are correcting, and we need to have simple rules that A, make for legitimacy, which I think is a major concern, and B, do not offer too much room for manipulability. And I think complexity provides lots of entries for manipulability.
Thank you very much. I think Frederick is asking
to comment, to react a little bit on my colleagues. Our colleagues have the luxury to think about the steady state, and we are in charge of the transition. And may I say, the transition, actually the management of the transition is particularly important in the current environment, and as I've said, in particularly complex given all the other elements beyond the regulatory framework. Second, in terms of lending, I would not underestimate the impact of liquidity ratios. If there's one of the key lessons of the crisis is that precisely the banking sector was not paying enough attention to liquidity. Capital was managed relatively strictly, scientifically, but liquidity probably not. The amount and constraints on our activities of the liquidity ratios will be probably as important than the capital ratios, and these are the two things which needs to be looked together. And third, on the return on equity, I would like to agree, but the problem, you need to spend more time with our investors. I think they need more education sometimes, and I would be delighted to speak not just about that.
Thank you. We have investors in the audience, so I think there will be a possibility. Before we move to the audience, let me ask a last question, which has always been in the forefront of the EBA's activity, and the European banking system and the regulators have been criticized in the past severely on the lack of sufficient transparency on European banks on a consistent basis. So we at the EBA took this issue to our heart and tried to improve on this. So on the occasion of the 5th anniversary, my question would be, how have we done? How does the transparency on European banks in the single market compare to global standards or global best practices, and how much have we improved? Jaime, and then Mario.
Well, I think I will be very brief and I will concentrate on a couple of points. One, my answer is an unqualified yes, very good work. I am very fond of these transparency exercises that EBA has been doing. I think, and all the other exercises where the EBA participates, and the common definition, the single rule book are very important part, the comprehensive assessment, the stress tests, exercises, all are very important. I think on these areas, what it is important for EBA is to, I would say, think about it, learn, is still a learning experience, learn from the past, learn from the previous exercises. There are things that can be improved and need to be improved, and I think this is the direction. And just two additional points. One is, I think one of the critical points in terms of transparency is trying to link the accounting and the balance sheet from the accounting perspective and risk management. And on that, I think there is work to be done. And I would say that there is one piece of work that I find it also useful, which is this EDTF task force that presented very simple procedures to link better a balance sheet and risk management. And I think this is a way, and I'm very happy that the usage, there is more and more banks that are using this thing. And my final point is, I think transparency is extremely important. I would like also to see a little bit of better use of the transparency on the part of those that are using the transparency, because there is a huge amount of data, and I am a little bit concerned of the use of that data, in the sense that it seems that nobody is looking and suddenly everybody is looking, and there is a risk on that happens. Okay, this is not consistent with a continuous flow of good information. It's good to have good information. It's also important that this is properly used.
Thank you very much. Mario, very briefly.
Very, very briefly, because I think this is the perfect closing question. Unqualified, yes, definitely is an area where you, Andrea, and all your colleagues did a fantastic job with the annual assessment, the transparency exercise, and so on and on. If there is one thing that maybe still to be done, is maybe improve the comparability of the bank disclosures. I think we got to excellent bank disclosures. Comparability of the bank disclosure is to be done. And the last point, if I can make a commercial, is for our call for evidence, which is another form of transparency. Because now that we have disclosed much better the bank's balance sheet, with the call for evidence, we try to see how the rules have impacted on that. Thank you.
Thank you very much, and thank you for this really, really rich discussion. But it's not over yet, because we will have the possibility of the audience asking short questions. I would like to ask anyone who is posing a question to identify him or herself, so that the others would also know. And if you'd like to address the question to a specific speaker, then please state that. If not, then we will pick up the question as appropriate.
Thank you very much. I'm Alin Jacob. I'm representing financial services users, both on national level in Romania and on EU level, level 1. I'm a member of the Financial Services User Group set up by the European Commission and of the EBA Banking Stakeholder Group. My question will be about enforcement. Enforcement of the EU legislation is now the most important challenge for consumers and consumer protection in banking services. Many EU users of financial services are now not benefiting from key EU regulation because of missing sometimes capacities, sometimes even non-existing mandates in consumer protection for national supervisors. My question will be very short. Do you think that the future work on supervisory convergence could provide significant improvement in this area? Thank you very much.
Thank you very much. So the question is, should the future efforts in the supervisory and regulatory repair focus more on the consumer angle and the consistency of consumer protections and the interest of financial users? Who would like to comment on this?
I'm not in charge of consumer protection, so I will let the people in charge respond.
I'm also not in charge, but we published a retail green paper, obviously. We published a retail green paper with a consumer angle. We acknowledge that clearly in the past we have looked more at the wholesale the wholesale side for obvious reasons, because as the Commissioner said, we had to firefight. But now I think it's time to look much more at the consumer angle. And there was one very correct thing in your question, which is what we need to do is really to create the internal market for retail, which is not yet there. Thanks.
Thank you very much. And as a comment from myself, being from the EBA, I think what I can state is what we have been seeing in the last few years is an increasing number of mandates reaching the EBA in the consumer area, and an increasing focus within the EBA on the consumer aspects and consumer angle of our regulation. So I can confirm what Mario has just said. Any other questions or comments or interventions? It cannot be that we have discussed everything of interest. Yes.
Yeah, Dan Hardy from Central Banking magazine. Just about one specific regulatory initiative, which is the ECB's ANACredit database, which, as I understand it, is going to oblige banks within the Eurozone to start providing quite a granular level of data about the loans that they make. 3 questions. First of all, do people think that it's going to significantly add to the regulatory burdens on banks, and perhaps smaller and medium-sized banks in particular? Secondly, does anybody have any concerns about the confidentiality of that database once it's been established? And thirdly, when I've spoken to the Bank of England and other major regulators, they seem to have no plans to institute some kind of database along the lines of ANACredit. So I'm just wondering, perhaps, if anybody can shed any light on why the ECB seems to feel that it needs an ANACredit-style database to perform proper regulation, but people like the Bank of England and the Fed don't seem to think that.
Thank you very much. I think on this account, Daniel cannot claim that...
I guess I should respond. Well, first of all, for those who are not familiar, it's a credit register, ANACredit, that was decided and started in the ECB for the monetary policy side, long before people knew that there might be a supervisory part in the ECB one day. Now what is implemented is the first block regarding ANACredit, where there is exactly 0 supervisory requirement. At a certain moment we will have to decide what we would like to ask as supervisors to use synergies and to do our job better with the support of credit register, which, by the way, is the case in many SSM countries. There are credit registers that are used by supervisors. Well, I know it is pretty demanding. I personally believe that there is a matter of level for the requirement of the information, which is maybe, I don't know, again, I have no legitimacy to discuss that because I'm not part of the people that decided. With a slightly or more than slightly upper level for requiring the information would probably be more easy and more proportionate. This being said, again, I don't know it. That's a serious caveat because I was not part of the previous discussion and I have not asked anything. I am not involved in this first block. Confidentiality issue, that I know in the ECB, they are quite good, really, my colleagues, on security in the ECB, confidentiality issues, so that I would not be too fearful. That will certainly be very well done. For the rest, it was about Bank of England, so I use my joker for that.
Thank you very much. Gerhard?
Yeah, very briefly, I think the person from central banking is absolutely correct. We believe, on the first question, that this will add significantly to the regulatory burden, not from the typically prudential regulation, but in this case from monetary policy. We believe indeed it's too granular if you ask for 100 attributes for a loan. And this does not affect just banks who have to implement this, but also the non-banks, the borrowers. In many cases, this information is not available at this point in time. And I guess there will be some difficulties to convince the borrowers that this is needed. On the confidentiality, I think this could be resolved, and the ECB has improved on this. The final answer can only be given once the credit register is established. On the Bank of England, yes, the question behind this is, are we creating sort of competitive disadvantage, or do we have a different level of regulatory burden within the single market? And Commissioner Hill this morning rightly was speaking about the single market. Thank you.
Thank you, Gerhard. Let me check if we have anyone who would like to take the floor. If not, then I would like to extend my thanks on behalf of our team to the speakers of today. It was very interesting. I think the messages you voiced are very, very clear. All of the positives and the not so positives, or the lessons learned from the process. I think there is a very good and legitimate justification for the next panel, which will be talking about what to do in the next 5 years. We could clearly hear that we are in the middle of the road, so we have to continue in a way to complete what the objectives we set. So again, thank you very much for having accepted our invitation and having been an excellent speaker on this panel. And we will hope to see you back in 5 years. Thank you very much, and I'd like to ask the audience for a vote.
Ladies and gentlemen, we now invite you to take a coffee break downstairs, and we'll see you back here at around 11:40 if possible, please. Ladies and gentlemen, we are now ready to start with our second panel. I would like to invite you all to go back to your seats now. And while people are finding their seats still, let me please just give you some information on this panel discussion, moderated by Guntram Wolf of Bruegel, and entitled "A Single Market for EU Banks, What Lies Ahead." Panelists will discuss the EU Single Market project for financial banking services, looking at the challenges and opportunities that still lie ahead for both regulators and institutions. From mitigating fragmentation processes to strengthening the EU financial system, panelists will tell us their views on how a transparent and consistent single market in banking can bring real benefits to all participants, consumers and businesses alike. The debate will again be followed by question and answer session, and the moderator will let us know once the time for the question has arrived. So I will now pass on the floor to the moderator, who will introduce you to the panelists.
Hello and welcome to the second panel. My name is Guntram Wolf. I'm the director of Bruegel, the economic think tank based in Brussels. And I have the pleasure and honor to moderate this panel, which looks at the single market for EU banks, what lies ahead. Now, I've never chaired a panel with 8 panelists, I have to say, and with 1 hour.
You never take part in such a big panel.
So what I thought I would do is really get very journalistic style answers with some key messages. Get everybody to speak 2 times for 2 minutes. I mean, that gives me a little bit of reserve so that we also have time for questions of the audience. and can then have a discussion. Now, of course, thinking about the single market and what lies ahead, immediately being in this city raises the question of the negotiations that are ongoing between the EU and the United Kingdom on the future membership of the United Kingdom. And of course, therefore, I want to ask my first question to Andrew Bailey. I have here a roadmap, but it's actually flipped, so I have to look always on the other side. So Andrew, Andrew, you were quoted yesterday in the day before yesterday in the FT on the deal that not the deal, but the proposal that President Tusk came out with, saying that. The bit about respecting the rights and competences of non-participating member states is a good piece of language, but where is the substance? So I think this is, of course, a key question because we have banking as a single market, but we have at the same time an infrastructure that is being built up that is concerning banking, and that really is a Eurozone infrastructure. It is clearly at the same time a single market issue because banks operate in the single market. So what I'm wondering is whether you would like to comment on this issue and add to this question whether effectively what you're suggesting is that we need two different regulatory approaches, one that is in the Eurozone and one that is for countries outside of the Eurozone, and if that is the case, whether that wouldn't undermine the future of the single market. Please.
No, I'm happy to do that. I mean, well, let me start by saying that is not actually that's certainly not my view. I mean, it's very important to have a panel on the single market. I think it's absolutely crucial in all of this that we remember how important the single market is. It's sadly not always fashionable, I find, to say that you're a great advocate of free trade, but I am a great supporter of free trade. It's absolutely a crucial thing, and the single market, of course, has been a major contributor to the sort of, in a sense, the embedding of free trade in Europe, and we don't want to, we should not wish to lose that. What I actually said was in response to what's come out in the initial documents, and of course you have to bear in mind that this is very much, as I understand it, and we're not involved in it, a process that's ongoing. There are, I think, very sensible words in those documents. It's got encouraging language in it, and it very much fits, I think, also with what Jonathan Hill was saying earlier about having mechanisms such as the one that he's established, which essentially, allow sensible review of policies, and importantly, as he said, allow principles like proportionality to be brought in. And I think that if you then bring that back to the question you asked about the SSM banking union and those of us who are not in it, I mean, we have said all along, we are big supporters of the SSM and the banking union. I can honestly say to you that we have found working with the SSM since they were created an extremely good thing. It's a good relationship both ways. We are very pleased that how it's going. And this is not about, therefore, what the language, that about the euro area and the non-euro area, the SSM and the non-SSM, is not about us going our separate ways. It's about enabling the SSM to do what they need to do, which is to, in a sense, establish a single approach to supervision, which is what we do. I would do the same thing if I was in their position, and saying, there is a role for differences. I think that's where the point of subsidiarity comes in. It's the final point I'd make, which is what I was actually discussing in Parliament when I was quoted on it. But that must respect the single market, it must respect free trade. I think there's a role for always asking the question when we make rules, do we need to make these rules? Do we need to go to this level of detail to preserve the single market? Often the answer will be yes, sometimes it may not be yes. And just to finish, I also made the point which was quoted, this is very important, I've made a point to the Parliamentary Committee. If the UK were to leave, Do not imagine that there would be a bonfire of regulations at that point. That is not going to happen because, as the previous panel was discussing, this is a common response to a major crisis.
Okay, thank you very much, Andrew. I see here the clock right in front of me, so I'm going to turn now to a European lawmaker. Of course, for you, this whole issue of regulation that is actually currently made in Brussels, and a lot of that regulation is actually passed in the European Parliament, in the Econ Committee, is critical. I mean, how do you see this whole debate that is ongoing now between the UK and the EU?
Well, for me, of course, the most important thing is that at the end, we have a result that the United Kingdom will stay in the European Union. I think most of the lawmakers, well, there are some, of course, who have an opposite opinion, but most of the lawmakers in the European Parliament are very much engaged in this topic. For example, we have organized a special group within our political group only dealing with these United Kingdom topic. And you can see also that I'm sitting here today or this morning. Normally our chair from our committee, Roberto Gualtieri, would have been here, but he has to represent his political group in the UK negotiations today, this morning in Brussels. So we are very much engaged. For us, it's absolutely important at the end that the United Kingdom will stay in, and of course we will have some intense weeks to go until the European Council, and I'm personally sure that at the end we will find an outcome which will, on the one hand, be sufficient for the United Kingdom, for the Prime Minister and the government to run the campaign to stay in, and on the other hand, of course, for Europe, the European Union, that we could politically live with the outcome of the negotiations.
Okay, excellent. Let me now turn to Jose Antonio to ask you, I mean, running a major European bank with lots of activities, of course, also outside of Europe, but a lot of activities also in different countries in Europe. I mean, do you suffer from regulatory fragmentation? I mean, there's the international dimension to it. Of course, and I think there's some interest also in the audience, because we haven't discussed in the first panel, you know, whether there's a regulatory divergence between the US and Europe, and perhaps Latin America, which is your business. So is that a problem for you? And of course, how do you see the internal European debate going forward? How would that affect you as a CEO of a major bank?
Okay, as you said, regulation, I don't qualify regulation as a problem. We had a major crisis a couple of years ago, and to bring a new regulatory framework was a need. It was not a luxury, it was a need. And we are going along this process. We went during 7 years along this process. And being a CEO of a large bank, we are always a little bit impatient due to the fact that we receive plenty of pressure from the market and we love certainty. And this is something that we are missing in all this process. We always ask for more certainty about future regulation in order to take the decisions that we should take. Going into the question you raised, divergence between, naturally there is divergence. We have countries in which they are still, let's say, in Basel I, in countries in which we operate, countries that don't accept internal rating-based models, so we live with different regulations in different countries. Finally, when it comes to the consolidated balance sheet, we apply naturally the European regulation as we are based in Europe. In relation with, and this is much more important, the single market, is still the single market fragmented? Yes, it is still fragmented. Okay, so this is a fact. This is not, every practitioner knows this. When I look at the institution I do represent here, we have businesses in almost every country in Europe. but we have a subsidiary in almost every country in Europe. In some cases it's by choice, because our model is subsidiaries, independent subsidiaries in capital and equity. In some other cases it's due to practical terms. There is not, naturally we made significant advance with SSMs, with the single supervisory, with the single resolution board, with the ECB, but still plenty of small rules that apply on a local basis that advise us to have subsidiaries at the local level. If I were to mention the most important point to reduce the fragmentation going forward, will be the single deposit guarantee scheme. Right. This, in my mind, what makes the euro in Finland the same than in euro in, let's say, in Portugal. Now it's not the case because it's intermediated by multiple factors that all of you know.
Okay, brilliant. Let me now turn to José Viñals. José, of course, you have been following the financial developments in Europe and around the world for many years, but are very involved also in all the discussions on banking regulation. You have strong views on banking union, on the heterogeneity of Europe's banking landscape. So I'm wondering, where do you see sort of banking regulation going forward in Europe, but also globally?
If we start with Europe, I think that the important thing is to finish the building that has got started. José Antonio was just making the point of how important it is for banking union to have a common deposit guarantee scheme. I would also say that it's very fundamental to have an adequate interpretation of the single rule book, so that it is a single rule book not only in theory but also in practice. The SSM, which is now implementing its supervisory mandate, needs to really deepen the collaboration between Frankfurt and the national authorities to get a good idea of each of the significant banks that they are developing. And I think that last ELKE's operation needs to be really become fully operational. So I think that all of this is in the realm of implementation. But I would like to add one issue, which is that in addition to banking union and in addition to the project on capital markets union, of which we may speak later, there is something that bothers me in the European financial architecture, which is about financial stability. And the question is, who's in charge? And the answer could be everybody or nobody. And the truth is a combination of both. Because there is a body which has all the right stakeholders, the European Systemic Risk Board, but which doesn't have real powers, only to issue recommendations and warnings. And then if you look at who has the powers, it's all over the place. You have the national authorities on many things. You have the European Central Bank for something. And I think it is fundamental that when we complete all the regulatory architecture and all the supervisory architecture of the European Union, we find a solution for who is in charge of financial stability. And this is a problem that is not just a European problem. I think that there are other countries which are grappling with this situation outside of the European Union. But I think that in the European Union is a particularly important issue to be settled, because otherwise what you could have is different important bodies pushing in different directions, each under the following their own mandate, which I think is fine. But if there is no overarching de facto strong architecture on from the financial stability viewpoint of someone being really in charge of financial stability, I think that we have a deficiency, and that's something that needs to be solved over time.
Okay, thank you very much. Of course, implementing what is decided is always important, and clearly assigning responsibilities is important, and implementing regulation coherently across the entire jurisdiction is also very important to have a level playing field. So I'm wondering, Elke, you are now running the Single Resolution Board. That you were told, José just mentioned that it's not yet fully running. So I'm wondering. So I'm wondering where do we stand there? I mean, is this a half-finished house? And are you surprised that so far you haven't had so much to do? I mean, not any major bank that was resolved yet. I mean, what's your view on this?
Perhaps let me start with something I've said several times. I think the SRB doesn't define its task in sitting there and waiting for customers to line up and then to resolve them. We see the SRB, and clearly this is work in progress, but it's not a half-finished house. We see the SRB very much as a forward-looking exercise. So our key focus is on resolution planning. We have started last year. Resolution planning will be the headline for this year. What does it mean? It means really putting into place resolution plans for all the major banks under our remit. As Dominic is sitting there, not for all, but for a large part of them, and to put in place what's called the so-called internal resolution teams. And when I'm saying we, then it doesn't just mean Brussels, the Single Resolution Board, it's us together with the National Resolution Authority. This is clearly, like the SSM, a mechanism, which is, and that's going a bit to your comment, the industry, investors are looking for clarity. Clearly, one piece in this resolution planning will be how to set the minimum required eligible liabilities, so de facto the amount of capital we require for the most important banking groups. This is part of this entire equation. We've started out, and we've put actually something also on our website in saying what is the general framework we are working off, and that's where this sentence comes from, that for the larger banking groups this is expected to be de minimis, but case by case probably well beyond the famous 8%, but this is just the frame. That's the quantity. It doesn't say anything about quality. All that work has to come. But also, to pick on another word, now we're not talking about a single rule book, but one thing is pretty clear when you go into resolution planning. A number of the rules we have to focus on, or we have to at least keep in mind, are not European harmonized rules. When you talk about creditor hierarchy, insolvency law is still national. We have seen some movements in various member states. So I think here could be an area where, well, I full-heartedly agree that we should now implement what has been decided, but clearly there could be the one or the other area where we need improvements to make the system more transparent and more consistent across at least the Eurozone, but probably also making it with that more efficient for Europe as a whole. Okay. I'm not calling for harmonizing insolvency law in totality, but there might be a lower hanging fruit called creditor hierarchy for financial institutions.
Thank you.
Right. Okay, Elke, let me turn to Eduardo now. So clearly, as a national prudential supervisor, you are in the everyday business of applying what is decided in Basel, what is decided in Brussels, and ensuring that the way it's applied, it's consistent and coherent with what is being done, ideally also in other countries. So what is your view there? I mean, is perhaps two points. One is the implementation of common rules, and the other question is, are we harmonizing perhaps a bit too much on the rules side? Perhaps we need more country-specific rule frameworks to cater also for differences of financial structures, financial systems in different countries. I mean, where do you stand on this?
Well, to be clear, we are partisans, and we have always been movers behind the banking union, and this is because we think that more harmonized rules in a monetary zone do make a lot of sense. But today, and in the context that we have with these discussions on the single market, I think it's very important also to convey the idea that we have in front of us the very big task of achieving the right balance in finalizing the regulations at the international level, and then implementation of these regulations that will be discussed at the international level. And for this, to be able to deliver a good task on this, we need more consistency at the whole European level, and not only at the banking union level. When we are dealing with this task of achieving the global reform for the banking system, we need to be more consistent also for all European Union. I live it, I will say, every day at the Basel Committee. We need to be all the Europeans and to get our ideas in a more consistent way ahead. So for this, I think normally that should be echoed in a consistent also transposition in Europe, where the single rule book is an enormous thing that's enormous add value. And I think we are talking about EBA. That means that the role of EBA will be enormous also in achieving that, this consistency for whole Europe, in order for the whole of Europe to be of more weight in the international discussions. And this is how we will do it. And we need more convergence, and we should try to converge together on more efficient incentives, because we've seen that all these regulatory but then implementation will have to strike a balance between more safety and the profitability of the system. Then the only way out of this is to increase efficiency. So we have to design our supervisory action as well as the implementation of the regulatory framework in a way that fosters efficiency. And just a word, we are not only prudential supervisors, we also are consumer protection supervisors. Someone was asking where they were. We are here because now we see that consumer protection and prudential should have links. We are also supervisors against the fight against terrorism, you know, a big issue in France. So in all these things, we should look for efficiency in the performance of these missions. We cannot be behind each consumer, we cannot be behind each person. We need to have regulation that fosters efficiency in the use of resources in the financial system, to protect adequately consumers, to fight adequately against terrorism, as well as to foster the economic efficiency of the banks.
Thank you. Let me turn to Chris de Noos. I mean, how do you see the banking regulation challenge going forward really in the next years? And are the interests of the smaller banks, are they properly taken into account? Or are we now with banking union basically constructing something that is only for the big banks and driving out all the heterogeneity that the banking system has, and basically we end up with only big banks supervised by the ECB and not resolved by Elke?
Well, I would say, as the representative of decentralized banks, local banks, we always are fighting with one problem. When regulators make regulations, they have in their mind always big institutions. I can refer to Basel, for example. Initially, it was conceived for the 27, 28, and I almost quote, international operating banks. And from there, it comes to smaller institutions. So the concept is already I would say that we are already in a defensive side to say, okay, but you have also to take into account smaller institutions, decentralized institutions. That's for us a challenge. And it has already been mentioned in the previous session and panel. We need proportionality. I'm very happy that Commissioner Hill, ANDREA mentioned in their speech. But now the challenge is this proportionality. It's almost accepted, this principle, but how will we make it concrete? We have already some principles, also the report that we made in the banking stakeholder group, but how will we make it now concrete? How will we make and find objective criteria to implement this? Other challenges for us are, of course, also low interest rate margin, has not been mentioned yet. To some extent, together with Beuk, we also have to defend the saver. And currently, the interest is very low, which is on the long term could raise problems. And the other challenge, as you asked for, is, of course, digitalization. Digitalization, it's really disruptive. It's a game changer. I think maybe it will be one of the questions.
That was my next question.
We will have to see and to review a lot of things.
Okay, excellent. You already preempt my question, my next question, which goes to Monique. Monique, I know you're very interested and have worked on, technology, digitalization, big data, and the way it transforms the financial industry. And I think also on the previous panel, we've heard that this is a major source of concern for many big banks that they get squeezed out or have at least very huge investments to do. So where do you stand on this? How do you see this?
We call that healthy competition, by the way. But let me first make a few general remarks, maybe, because first of all, I would like to wish a happy birthday to EBA, and I would really also stress that we appreciate, as consumer organization, very much the developments of outreach to consumer organizations and working better together. So I hope the 5 coming years will be as good as the last years. I would also like to stress I'm a consumer representative, so a little bit an exotic animal in this panel. That's why I dress differently a little bit. And I'm not a financial expert. And I have to admit, the panel discussion this morning and now, it gives quite a headache. Huh? The jargon is totally hermetic for somebody who doesn't work on a daily basis on financial services. And I have been part of the Liikanen group, so I know a little bit about, capital requirements and all that. So just to tell you, think about it. Is that the language that you use if you reach out to people? And if you speak about capital market union, people out in the street won't know at all what you're talking about. So, but it's not. It's semantics matter. It's very important because there is also a tendency that the regulatory conversation is too bank-centric. Look at the title of this session. An EU market, and a single market for EU banks. Why for EU banks? For EU financial services. But not only for the banks. Where are the other stakeholders in this process? Why should there be a creation for banks only? It's for the whole system that there should be a single market. So just to say, semantics matter and make it open. Also, if somebody could tell Mr. Hill, better regulation is not only about analyzing before you regulate the implications, quote, the costs on business, it's also to check the implications on other segments of the society and also the benefits of regulation. So if you don't tell him, I will do it anyway, because it's very important that he knows that there must be a balanced approach. Now, concerning problems that consumers face for the moment, there has been a lot of regulation, that's for sure. There have been very good consumer protection measures introduced since the crisis. But on the ground, consumer trust in financial services goes very low. It's not.
So will consumers go then to digital?
Yes, yes, digital. You want really to push me into the digital discussion?
Yeah, I want you to.
Okay, but then I would like in the second part to have.
Why are consumers not switching to Bitcoin?
Well, I think that first of all I think that disruption, it's a little bit like, the Airbnb and Uber discussion. Disruptive initiatives, certainly with with technologies, are new, and people are of course a little bit concerned because money is very important for them, so they want to be safe. Banks provide them, or are supposed to provide them with the safety of their money. So, and the problem also, it's not only Bitcoins, it's other innovative solutions. The problem is that there is no interoperability and that the new solutions are not being accepted by the merchants. So there is not, even if the consumers would like to push or to use innovative solutions, they don't have the market behind them to have an alternative for banks. And also, by the way, there are opportunities, and we like the opportunity side of financial innovation and on fintech solutions, but there are also challenges, because the privacy challenge is, of course, also very important, and the security challenge behind digital innovation. So we still have to analyze, of course, this sector. We look at it as really a way of putting also banks into a more competitive environment, because the business, can I say, a little bit provocative as always, it is a little bit dusty. Huh?
Right. Okay, thank you. Thank you, Monique. So let me turn to Jose. I mean, you've heard, of course, the very strong point that, you know, at the end of the day, financial services, we shouldn't talk about banks, but we should talk about all financial services, and we should talk about the interest of, you know, greater society, not just about narrow financial stability concerns. So one big initiative that is being discussed at the moment is, of course, Capital Markets Union, which is sort of seen as a way to enrich the ecosystem of financial intermediation in the EU as a whole. So go beyond a very strong bank-based system towards a system that has alternative sources of funding. And there's, of course, also some recent research by Professor Pagano, for example, that shows that countries that have a more diverse financial system tend to be safer on the, with less financial systemic risk and with better growth performance in the long term. So is this the right way to go? I mean, we try to broaden up and diversify the way the financial system works to have better growth and less financial crisis and better benefits for the consumers?
Yeah. I think that the evidence that you're quoting is consistent with the evidence that we also have, which is that after a certain level of development, countries tend to benefit from having a more diversified financial system. And the case of the European Union is very much to that point. It's a system which is very much dominated by banks. But at this point, there is, it would be good to have some better balance between bank and non-bank sources of finance. And I'll just give you one example. In the United States, if you look at the role of integrated capital markets in smoothing economic fluctuations, when shocks hit the States, about 40% of these shocks to the States are smoothed through capital markets. And this is quite a lot more than what is smoothed through the federal budget. So capital markets and integrated capital markets can play a very important role in two dimensions, in terms of risk-sharing, in terms of ensuring more stability by allowing better risk diversification across countries, and at the same time by providing alternative complementary sources of finance that can support growth. Now, having said that, one of the most important contributions that the capital market unions can make is to provide not just or not mainly debt sources of finance, but equity source of finance. That would be most complementary to what banks do, and at the same time provide source of finance which can be used for small business and also for new business. But in order for the Capital Markets Union to be fully successful over time in achieving its goals, it needs to be accompanied by other policy initiatives. For example, by an appropriate regulatory and supervisory framework, contrary to banking union, where you have a centralization of supervision in one place, the SSM. In the case of capital market union, the oversight of the system is very decentralized, and you are far from having something like a single rule book. So it is very much behind what has been achieved in banking union. And as we know from the international discussion on shadow banking, it is very important that as you advance the role of markets, you have an appropriate oversight so that you have an adequate prudential framework for non-banks. But there is also something which is very important, which is that tax reforms that eliminate the debt bias and therefore make for a more proportionate tax treatment of debt and equity. That's fundamental to avoid this implicit subsidy to debt. And last but not least, if we're talking about capital markets union, which promotes financial instruments that help finance equity, you need to do something about national insolvency regimes. Elke mentioned this before. There's some low-hanging fruit there that can be caught without too much trouble, and I think that that's something. Some actions there would be important. So, capital market union, yes. Over the long term, over the short term, is more complicated. But if you want to accelerate it, there are many other policies that need to support it.
Okay, Andrew, Capital Markets Union is of course a project for the 28. It's about deepening capital markets and strengthening the stability of capital markets and increasing the cross-border dimension of capital markets, including in equity markets. Now, the Bank of England has, of course, issued a report on this and related matters, where you come to a little bit of a different conclusion than José, it seemed to me, because José very much mentioned this importance of having some form of a supervisor that takes responsibility of the stability of the entire financial system. While the Bank of England seemed to me to fall more on the line of saying, well, perhaps that's not quite what we need, because at the end of the day, we are still in charge if things go badly. So we really have to be in charge of supervision. Do we have a tension here between a proper and fully, deeply developed capital market?
I'm not sure about that. I think, first of all, like Jose, I think Capital Markets Union is an extremely important element of the next step of developing the financial system in Europe, because it will create two things. It will create alternative sources of finance. It'll reduce the dependence on banks and therefore the exposure to the cycle and the credit cycle, if you like. Secondly, it tends to put assets which are not suited to being on the balance sheet of banks because of their deposit funding into asset markets and onto asset management vehicles, where they should be providing it's transparent what they are, if you like, and what's in the can, to use an American phrase. Now, on José's point, I think José's making a point about financial stability policy, and it's an important point. I think it's important that in a world where we've got more than one currency in Europe, that we therefore have more than one monetary policy. That's entirely natural and given. What we discovered in the crisis was the need to have, alongside monetary policy at a macroeconomic level, a set of macroprudential policies which can be used. They can be used for a counter-cyclical purpose, but they can also be used in a broader system stability purpose. But I think they have to, and this is what is provided in CRD4. They have to be there at the level of the currency because they are the direct, if you like, partner of monetary policy. However, clearly you then have to have sensible coordination. And I think, I'm very much with Jose about saying, I think that the way in which those policies are made and coordinated, were made in at least in one part, and coordinated more generally, bears some examination. That's not surprising. I mean, this is frankly, a very new and nascent area of policy making, and I'm always struck when we talk about these things, how much, if you like, explaining we have to do about what macroprudential policy is, what its role is, what it does and doesn't do, because it's not as simple. It's not as simple as monetary policy isn't simple per se analytically, but it reduces often to a single target and a single policy instrument. Macroprudential is much more complicated than that. It's got many elements to it.
Right. Okay, let me turn again to our European legislator. So what are you planning there on? on capital markets union?
Well, let me first say, of course, from a lawmaker's perspective, we are quite positive on that proposal now for a capital markets union. For us, it's very clear that we will have to deal with that on a middle or long-term perspective. And as you rightly said, we just started with the work on the capital market union. As you know, securitization is on the table and the prospectus directive. The proposed securitization regulation is, for me, a major piece of the capital market union project, so it's good to start with that. And the securitization project might be helpful in some areas and situations because securitization can free balance sheets of banks, but the banks must be willing and actively grasp the opportunities. And on the other hand, on a global level, fears grow that the enormous corporate debt might herald recessions. Credit markets are in a bad shape. Rating downgrades have surged. A third of companies worldwide are earning too little to serve debt. And last but not least, corporate leverage is at the moment at a 12-year high. So at the end, capital markets union must go beyond targeting credit supply by banks only, for instance, providing low-cost opportunities for companies and retail investors too. Last point, for us, it's absolutely crucial that at the end, and was already mentioned by my neighbor, we should achieve a more balanced approach between banks and other sources of funding. But at the end, there can't be a replacement of the banks by other sources. That's, from a lawmaker's perspective, the crucial point.
I saw, Chris, you wanted to jump in. I mean, perhaps to push you a bit also. I mean, so are you afraid that we're talking here about sort of a shadow banking system, that is being built up?
Capital markets union. I just wanted to raise a question to Jose and the previous speakers. In Europe, 1% of the European companies have more than 500 employees, or 50 employees, sorry. 92% have less than 10. Less than 10. Do you really think that those companies will go to the stock exchange to have capital? I think there are a lot of good things as well in CMU regarding securitization, covered bonds and so on. But as regards access to finance for SMEs, I think it should be the banks first, and it can only be complementary. I don't know whether you agree.
We still need small banks, banks close to the customer. That's the message, and I think nobody really disagrees. Andrew, very quickly.
Well, I disagree. I was going to qualify. Actually, capital markets union for me is much bigger than just financing for big companies, because I think if you say the banking system is going to be the source of equity finance for SME, and I stress the point equity, you're nodding your head. Yeah, it's not, this is all about creating capital markets in the broadest sense that can support equity raising for SMEs as well. So it's a much broader thing. So I would take issue with that sort of, the version it's only for big companies.
Right. Antonio, I see you. You're also very eager to jump in.
This is an interesting discussion, yeah. So because we always bring to the table, and in the previous panel also came comparing Europe with the States. This intermediate model in the States with Europe. Well, there's two questions here. In the States, the banks play apparently a smaller role, just because, well, there is the sponsor system for all the mortgages that goes to the Fannie and Freddie, and for the reasons the balance sheet are much smaller than in Europe. So the largest American banks have more or less the same size, but the balance sheet that the European banks, just for one reason, because all the mortgages went into a sponsor system created by the state. The second point here is why in Europe probably makes sense that the average size of the European companies will be much smaller than in the States, because the simple reason is they were growing into the national borders. For that reason, the national borders were much smaller than the States. When someone incorporated a company in the States, probably thinks in expanding into the States. When someone else was incorporating a company in Europe, if you were incorporating, let's say, in a country in Europe, probably was thinking in growing inside the country. So size, in this case, is important to have access to the capital markets. Theoretically, it's possible to have SMEs going into the market, but it's more difficult. It's a little bit more difficult for and we have had significant cases all across Europe where the information, in order to facilitate the access of those companies to the market, we reduce the amount of information provided to the market, and this may lead to a situation in which investors, at the end, investors are not protected and get into the nasty surprises sometimes, as we have had. So, naturally, as a bank, we are in favor of developing capital markets. The capital markets are not against the banks. So we are keen to develop the capital markets. This also helps us, and we are main actors of this. But having said that, Monique probably agree with this, investor protection. What we sell into the capital markets, the information we provide to the capital markets need to be good, transparent, accurate, and the smaller the size, the more difficult to follow this information. That's my point, yeah.
Monique, in capital markets, of course, consumer information that consumers get that want to go on the market and buy products is extremely important. And of course, the European Union has done quite a number of initiatives in the recent years, but I see you're skeptical. Is it not enough? Information transparency is not sufficient?
Well, there has been really a lot that has been done on disclosure, for sure, but that's not the main problem. When you look at the market as it works for the moment, there are a huge number of mis-selling practices when it comes to investments. And this is even more a problem now that more and more people need to save for their retirement because the system of pensions has broken down. So it becomes even more, let's say, a very important decision in your life. And we have, some of our members have done mystery shopping. It is a scandal what happens there with the advice that is being given to people. The profile of consumers in a huge majority of cases is not being checked. They just push the sale. The product. For example, in Germany, there was one product by a bank where the interest rate was linked to the goals scored by Bayern München at home. Very bad return that year. So, but I mean,
only that year.
I didn't check the other years. Anyway, this is not. This is the consumer loses out. So there is a huge. Let's say, malpractice in that area that should really be enforced. Second, you speak about disclosure. And in the first panel, I think it was Frederic, he said rules should be simpler. Okay, we are all in favor of simpler rules, but products, financial products, should be simpler. They become more and more complex, and more consumers cannot understand them anymore. Even the people who sell them don't understand them anymore. So, is it needed? Do we need such complicated products for the market? No, not for the consumer. Make it plain, make it clear, make it easy to understand, and you will have satisfied consumers if the return is fair. Right. And third, the last point I really would like to make, it's about enforcement. There was, in French, you say, un ange passa in the first panel, who is in charge of consumer protection, and there was like an hesitation. And here also, a little bit earlier, we said, who is in charge? Everybody's in charge, nobody's in charge. And for consumer protection, in the area of financial services, there is this hesitation. Who is in charge? Who goes out there and punishes and sanctions misbehavior? And there is a huge room for improvement and for increasing trust of consumers. Exchange of best practices. There are activities being undertaken by some national supervisors who are really great, will learn from each other. I think EBA could also, together with EIOPA and ESMA, try to coordinate, because there are all those joint, horizontal, cross-cutting issues between the three authorities. I just finished my sentence. that would be really stop the silo approach and go for coordination, because on the market there is a coordinated malpractice being undertaken.
Okay, let me use the last 5 minutes so that we have at least 5 to 10 minutes for questions from the audience to go back to the topic of banks, really, and who would be better placed than you, Elke, to talk here about banks. I think one of the topics that we've heard also in the previous panel is the relatively low profitability of European banks. When you look at the return to equity, it's lower than in the US. That raises questions about the sustainability and the questions also about exit. I mean, should there be banks that should be exiting the markets? As a former supervisor, you have already strong view, and now as a regulator, you as a chair of the resolution board, I mean, you're deeply involved in this. So, where do you see the profitability falling into this whole debate? Is that an issue, or that should worry you as someone who would eventually have to resolve a bank, or is that not at all a problem?
Well, I think it would be ridiculous to say that profitability is nothing we would care about. Clearly, you can only have banks that are servicing the economy when they are also profitable. And I think we shouldn't repeat what was said on the first panel about the challenges for the industry coming out of a low interest environment, digitization, all the changes, which are clearly a challenge to the industry. But going forward, I think the answer can't be, because the challenges are so big, you have to stop in making the system as a whole safer. So for me, the question is, it's up to the banks and their managements to consider their business model, to consider their options and how they can get into a sustainable business model. If they don't find a sustainable business model, then probably finding an exit out of the market. And now I'm not saying coming to knock on our door, but finding a private exit out of the market would be, for me, the most logical step. And I think it would be fair to say that Europe is probably not underbanked. So at that point, I think the question of profitability raises the question of how to address it if you can't earn your living sustainable. Now, this is, again, you're not talking about each and every bank. There are banks that can be small and very profitable. They can be large and very profitable. For me, it's not even tailored really to size. But that would be my general answer to that. And clearly, the other answer is living in today's system, implementing regulation, and I very much agree, we need to be efficient, we need to be proportional with all of that, but in the end, only a safe and sound system can really protect the economy. And I wanted to add one sentence on the capital market union, which is not my file, and I agree to a lot of things that were said, but one thing should also be kept in mind, not to open up arbitrage with open eyes. What you called shadow banking till the day before yesterday is nowadays potentially called sustainable market-based finance. Okay. So be a bit aware of potential regulatory arbitrage. Same risk, same rules.
All right. Eduardo, you have the last word, and so I don't even ask you a question because there's so many things to react to. So.
Just on 2 points that were raised, which are very important even from a microprudential supervisor point of view. First, if we want banks to be profitable in the context of also the capital union, market union, where we have to develop market finance, that we have to allow banks to diversify their own business model and to be an active part of role in promoting the capital union. So here in Europe, for instance, for structural reform, maybe is that one thing that we have to have in mind, that we must foster efficiency also by diversification of services given by the banks. That's the first thing. The other point is we need consistency across the market of financial services, and that needs that selling a product by a bank, by a financial intermediary, by an insurance company should be subject to the same things. And here again, the role of EBA with the other agencies is much more welcome, because this is what we need to have a real single market.
Perfect. So I'm glad that the last two words were single market. So that opens, because that's the topic of our panel. So let me open to questions. Please raise your hand and identify yourself. There's the question all the way in the back.
Yes, thank you. Peter Alstott, Thomson Reuters Regulatory Intelligence. Yes, it was supposed to be about the single market. Maybe I could try to dig a bit deeper with the two prudential supervisors on that. And no better talking point than just to quote Mr. ENRIA from this morning. It's a bit long, but I'll try to do it quickly. He said, an important question lingering upon us is whether the single rulebook's fit for purpose in the new institutional setup created by the banking union. Single supervisory mechanism of the European Central Bank has expressed its concerns that in a number of areas rules still differ within the Eurozone, hindering the smooth conduct of supervision. At the same time, the proposals for a new settlement of the UK within the EU suggest that this need for greater uniformity of rules might not be suitable for member states not participating in the banking union, which may need a different set of union rules. And then he said he was convinced that common rules and convergence and supervisory practice are essential, but nuanced that and said that the EBA would deal with this very delicate task. Now, I saw Mr. Bailey listening very carefully to Monsieur Fernandez Boyo. Mr. Bailey, can you elaborate and be a bit more granular about the Britain's or your position on this delicate matter?
Well, I mean, look, the first thing to say is that the core of the rule book is common for two reasons. One is because it's actually common not just in Europe, but actually globally, because of the role of Basel in the banking area. And of course, all of us are involved in the Basel process. Secondly, because a large part of the European rule book is actually maximum harmonized. And that provides essentially for a common approach. So I think it's easy to overstate this issue. I mean, we're dealing essentially with pieces of it which are sort of what you might call sort of more at the sort of edges of it. And as I said in my introductory comment I made, there the question arises, and this is very much what I might call the sort of, the accommodating different national practices, is how far it's sensible to have a single rule book for the very good reason that you're promoting the single market and free trade, and at what point you say, actually, I'm not sure we need to go that far to achieve the objectives of the single market and free trade. And I think it's a matter of saying, because by the way, that question, that's the subsidiarity question in a way, is in the treaty already. We're not talking about changing anything there at all, I think. It's about, to things that Jonathan Hill said earlier, it's about having a mechanism to pose that question. But I come back to what I said, this is very much at the edges of the rule book. I mean, it would be quite wrong to think this is sort of, in a sense, the sort of the heart and soul and large part of the rule book, which is common for the reasons I said.
Okay, let me take a second and a third question perhaps together. So the lady here and the gentleman there.
Yes, hi, my name is Judith Hall. I'm from the Swiss Finance Council, but I also happen to be a member of the ESMA stakeholder group. And we're just about to send a letter to the European Parliament about PRIPS and the key information document, about the fact that past performance is not going to be included in the key information document, which strikes us as strange. And we've been discussing this internally, and we're wondering, what happens if something goes wrong at level 1? What can you do to stop it? And do we need a little bit more flexibility between level 1 and level 2, looking forward into the future? And I think in the US, for instance, there is more freedom for the CFTC or the SEC, for instance, for no action type letters. And we all know that during the last 5 years, we were all involved, most of us talking about the rules, some of you drafting the rules. There was a lot of work and we make mistakes. So is it possible to somehow find a flexibility between level 1 and level 2 in the ESA review going forward? I think that's very important for ESA to continue to do the work that they have been doing.
And I suppose the question was addressed to Burkhard, but let me collect the third, please, yeah, the gentleman there.
Yes, good morning. I am Íñigo Barrera from ADICAE, the Spanish Banking and Saving Users and Consumers Association, all part of the 3 ESAs, stakeholders group, and the payment markets. Congratulations to EBA for their anniversary, and the best for the future, as it will be good for everyone and for us. In relation with the single market, in the practice, we have investors and savers, especially those small ones, need also single and global and effective solutions, as it means trust. For example, watching it now with the investors in the Volkswagen case or Bankia case in Spain, maybe stakeholders need and expect a definitive push as a solution, for example, for ADR, alternative dispute resolution mechanism, as it will be more trust on the market, as I said. And second, in relation with the digital disruption, the PSD2 directive, aren't we having the framework and the regulation after the disruption has taken place? Maybe you are a little bit late. Supervisors and legislators maybe have to work hand by hand, but quicker and get more specialized. Finally, also, there's an elephant in the room in this matter of digital disruption with the anti-money laundering regulation, which must be solved and dealt. Thank you.
Okay, thank you. Let me take, I'm not sure to whom this question was addressed, but perhaps someone can pick it up. Let me see if there's one final burning question in the room, the gentleman here in front, and then I give it back to Burkhard and whoever wants to pick up the other.
Thank you, Farid Ali from the European Consumer Organization. Well, I have just one quick comment. You talked about the low profitability of banks, but this also contrasts with what we see in the media every day. This or that bank had made a record profit this year and last year. So this is a quick comment. But regarding the enforcement, and Monique said that there is a strong lack of enforcement across Europe. In some countries, the laws are enforced at with very bad quality. And you talked previously about the single rule book regarding the supervision, prudential supervision. Do you think that there is a need for a similar rule book for conduct of business supervision? I don't know who can answer my question. Thanks.
Okay. Thank you. So Burkhard, perhaps you take the first one, and then Eduardo, you want to? Please.
Yeah, thank you, Guntram. Of course, we haven't talked about that question from Judith Hart, but well, for Parliament, it's a really crucial topic. As you might know, we have established these so-called scrutiny slots within our committee. At the moment, we are doing at least one of such a slot every month, so you can see the increased need to look for what is happening on level 2, even sometimes on level 3 measures. I would like to add, because we are on the EBA's anniversary conference here. It's not only PRIPS, of course, but this was an example for it. We have at the end of the month a PRIPS scrutiny slot, so we will deal with our colleagues then from Commission on that, and we want to discuss that. But I totally clear on that. I think we need much more flexibility between these different levels, and it is really important that at the end of the day, the Commission and even the ESAs acknowledge and see, and then of course put that into motion what level 1 has decided. So that's for clear. From Parliament's perspective, we are very much looking forward to the ESA review, and that is definitely a point we could really go into the debates. Well, at the moment, it's now the Commission's turn they have to put forward a proposal for the ESA's review. And I think besides that, there are many other topics, of course, we have to discuss now. After 5 years, the ESAs were in work.
Okay, enforcement of the different consumer protection rights. I mean, perhaps that's a question to you, Edouard.
Two things. First, I wanted to say that for the payment system directive and money laundering, EBA is doing work on both sides, so it will be a nice place to try to harmonize what will be the consequences of them, as it's not out of the reach of the European regulators. About enforcement, it's clearly, I will say, a step after convergence of practices. Then the last practice is enforcement. Enforcement depends heavily on national rules. Now on level 1 we have begun to harmonize the rules and also the possibilities that should be at the disposal of the authorities, but we have to see what they do with it before going a step. So I think it's on the European agenda, but it's not the next step. The next step can be PSD and anti-money laundering, and then we'll see enforcement.
Okay, we finish only 5 minutes late, so I did much better than the first panel. Again, congratulations to EBA, and thank you to all the panelists. Thank you.
Ladies and gentlemen, we are reaching the end of our conference, and I will now be joined by Adam Farkas, the Executive Director of the EBA, who will close the event.
Thank you. Thank you very much, Katrine. I would like to thank you all for participating in our conference today. I didn't know that there was a competition of panels, but had I known, I would have acted differently, probably. In any case, I understand we lost the competition of panels. This event, I think, has been organized as part of our commitment to full openness and transparency, as well as an opportunity to hear from you not only what we have done so far, but also to see what priorities we should set for the next 5 years. We are very pleased that our anniversary event has brought such a rich exchange of views in the opening speeches and also in the 2 panels we have seen. I think this serves as a compelling piece of evidence, and we are working on the basis of evidence, that what the EBA has been doing is highly relevant and important to the well-being of the European financial system. Based on the discussions today, we are confident that the EBA had a significant role in the repair process and will keep on having a strong role for the coming years. The regulatory framework created by the EBA for the functioning of a truly fair and efficient EU single market in banking will heavily depend on the EBA's work in ensuring convergence of practices and ensuring that the new rules at the basis of the single market are understood and applied by EU supervisors in a consistent way. So on the basis of this message which we received, we plan to turn our focus to completing the rulebook, review it where necessary, and I think we got very clear messages from the panelists today where it might be necessary, to enhance the consistency in implementation and ensure that consumers are better protected in this dynamically changing environment. As we are coming to the end of today together, I would like to wish to renew my gratitude to the Right Honourable Lord Mayor, as well as the City of London Corporation, for having offered to support today's event by offering this wonderful venue. I see this as a great testimony of the leading role of London as one of the world's financial capital cities, and also as a testimony of the commitment of our host member state, the United Kingdom, in supporting the presence of the specialized agency of the European Union, the EBA, in London. Last but not least, I would like to thank our brilliant staff for their dedicated and hard work over the past 5 years, and also the days preceding this particular conference. Some of you have been able to follow the proceedings here. Some of you have followed the events today through the web stream, but you have all been a fantastic colleague and a supporter of this large European project. So for a more relaxed conclusion, I would be delighted if you could all join us for a toast downstairs, which will be followed by a lunch. And one promise I can make, although people sometimes say there is no such a thing as a free lunch, this will be a free lunch. We will ask nothing, and you can enjoy it and continue the conversations and the discussions we have had today. Thank you again very much for accepting our invitation.